someone's infected for you to give it to someone else?
No. After a period of about 10 days, if you had a mild or moderate case, you likely have developed some levels of antibodies, although in the president's case, he has what are synthetic antibodies because he received the Regeneron product. But you're not somebody that's considered contagious to others. So there's a difference between contagiousness and immunity. Immunity is your ability to not be infected. Contagiousness is your ability to spread to others. And at this point, the president likely has some level of immunity and is no longer contagious to other individuals.
The president had a cocktail of course, medication that is not used by many people in the world. What have we learned about the efficiency of those?
Well, the part of the cocktail that's not standard of care is the Regeneron monoclonal antibody. This is something that is in clinical trials, and we're starting to hear some data about promising results that are coming out, that this decreases symptoms, it decreases the amount of virus in your body. And the president seems to think that it worked really well for him. And obviously, we can't make a generalization based on the use in one patient, but the clinical trial data that we're seeing trickle out does look good. And Regeneron has submitted for an emergency use authorization to the FDA based on their clinical trial data. So I do think that is all starting to come out, and we are looking at it as a promising treatment that might be a bridge that we use before we have a vaccine, because if it is something that can keep people from getting severely ill, that will take a lot of pressure off of hospitals, ICUs, and it will be something that will change the risk perception of the disease if we have something that works in this manner, because dexamethasone is more for patients who require oxygen, so they're already a little bit sick, and remdesivir doesn't have any effect or impact on mortality. It decreases your length of stay in the hospital. So if we have something that can prevent you from ever getting severely ill, that would be a really a major advance.
Dr. Dalja, J&J, Johnson & Johnson, halted, of course, this COVID-19 vaccine trial after one of the patients became ill, and they still can't explain it. It's early days, but how quickly are you expecting this trial to resume?
It's hard to say because we don't know exactly what happened with the J&J vaccine, but it's important to remember that clinical trial holds are very common, that this is just a pause to understand what happened, and it doesn't necessarily reflect whether or not the J&J vaccine will move forward or not. It's just that because even though this happens all the time, no one watches vaccines the way they're watching them now, so you're keeping track of all of these, and in normal times people are not looking. So we have to see. J&J's vaccine uses a different approach, uses a common cold type of virus that they've engineered to carry the protein from the coronavirus, and it is something that they've already used in their Ebola vaccine that is approved in the the EU. So it is a technology that's already been seen. So it will be interesting to see exactly what went on in this patient. But remember, many of these trials, many of these adverse events that occur that cause pauses aren't necessarily related to the vaccine. And it just takes a minute or two to look through this patient's history and decide whether or not this was something that was happening anyway, or just coincidental to the vaccine, or was truly related to the vaccine. And we have a lot of safety data on this type of technology from the EUA, from the EU approval of their Ebola vaccine in the past.
Amish Ajal, thank you so much, of Johns Hopkins there, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, a little bit later on, we'll also speak to the Johnson & Johnson Chief Financial Officer about this halting of the trial. That's at 10 a.m. in New York, 3 p.m. in London, and this is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. We're watching markets here pretty much a churn, but I gotta say the NASDAQ market continues to lift. That Apple meeting this afternoon, I don't usually say this. I don't really care about these meetings. Guess what? This one's different. It is hugely anticipated. Anticipated as well is the state of the microeconomics, the price theory of oil. We all remember the tumult there with negative oil prices for a brief time. The recovery that we've seen to $40 a barrel, West Texas 40.25, Brent crude $42 a barrel, and we need an update. The IEA's executive director, Fadi Birol, joins us right now. Dr. Birol, good morning. Thrilled that you're with us again. I'm absolutely fascinated about the distinctions you see in demand right now. What do you see?
Now, demand right now is trying to gradually recover, but the main uncertainty is the pandemic. Are we going to see a second wave of COVID or not will determine also the demand prospects this year. But when we look at beyond this, if the economy rebounds, as IMF and the others say, next year, we may well see global oil demand to come back to pre-crisis levels in a few years of time. And as such, I would say that we do not subscribe to those who say that the peak oil demand is behind us. It can only happen if the governments put strong structural policy changes in terms of electric cars, in terms of petrochemical industry and others. In the absence of major policy changes of the governments, with the rebound of the economy, I think we will go back to the pre-crisis levels in a few years of time.
In your wonderful outlook, you have a number of scenarios that you lay out, and anybody can understand, given the pandemic and the massive global uncertainty, I can really understand 2, 3, even 4 scenarios. In those scenarios, what is the variability for OPEC and the extended OPEC family?
So why do we come up with scenarios? Because the uncertainties are huge. We have never seen so many uncertainties, and one of them is critical. When we look at the oil markets today, in the past we were discussing about oil markets, refinery margins, investment, supply, demand, OPEC plus, IEA minus. Now the major determining factor is today coronavirus, how long it is going to be with us. If we see that the coronavirus is under control as of next year, for example, and the economy rebounds, we will see that the oil demand will come back to the 100 million barrels per day, and as such, it will give a space for the OPEC Plus and the other producing countries. But important message coming from our outlook is sooner or later, oil-producing countries need to diversify their economies because the value of oil is going down with the price expectations and the demand expectations. It is the highest time for them to diversify their economies.
Fatih, can you talk to us about Libya specifically and the fact that they could actually go back to production? Is this the worst possible time for the market, and what does it concretely mean for the price of oil?
Yeah. I think Libya increasing its production will put additional barrels and will be another factor which can pushes the prices down. I think two important elements now in the very short term: what will happen with Libya, production will increase or not, and how much it will increase. And the second one is what about the coronavirus? It is going to be under control so that the economies can start to recover, so that it can give a boost to oil demand growth. On the supply side and on the demand side, two uncertainties here.
All right, OPEC Plus is meeting soon. What will they decide?
It is, of course, up to OPEC countries to decide what they want. But what I see is that the recovery of the oil demand may not be as quickly as we or the others thought a few months ago, mainly because of the governments around the world not being able to have the coronavirus issue under control. As such, economic recovery may be delayed for some time, which means that the oil demand growth may be rebound, may be slower than one hopes to see.
Fatih, this is a really important conversation. Indeed, I would suggest this is a historic conversation, in that your note on sustainable energy really leading off your outlook today really is a clarion call for the hydrocarbon nations. Do you actually see an appetite by them to make this grand century-long shift?
I do see, compared to a few years ago, I do see there are serious intentions to diversify their economies. Look at Saudi Arabia. Saudi Arabia had a Saudi 2030 strategy which aimed to diversify its economies. Iraq, just the other day I talked with the Iraqi Prime Minister. He said as soon as we address this issue, what they have in front of them, political stability and the pandemic, they are going to diversify their economies. But now, whether or not they have the financial means, those countries, to do this, because as we all know, we saw this movie before, that they want to diversify, and it didn't happen. But what I'm seeing is there are two big pressures. One, demand for oil is weaker than before. Price of oil is weaker than before. This is the revenues are weaker. And the second one is many countries around the world are putting climate-driven, environment-driven energy policies in place, which will further put downward pressure on the oil demand. So they have to prepare themselves before it is too late, which means they have to diversify their economies beyond oil. And as most of those countries' economies are almost one-to-one indexed to oil prices. And it is very risky and, in my view, dangerous.
Fatih, what can you tell us about the U.S. elections' impact on energy supply? What does a Democratic win actually mean for energy and oil producers?
I think when I look at the programs of both of the candidates in the United States, they have different energy and climate policies. But if as you mentioned, Democratic candidate wins, it may have several implications. But two of them, I can say, looking at their program, they will be willingly to push the clean energy transitions even stronger. And the second, for example, if there was a discussion on the lifting the sanctions on Iran, which may mean additional barrels to coming to market, and which can again be an important factor for the oil markets. So these are two possible theoretical developments if such a political result comes out from U.S. elections.
Fatih, as always, thank you so much for coming on. Fatih Birol there, the IEA Executive Director. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. President Trump's diving right back into campaigning. He told an audience in Florida he felt so powerful after recovering from the coronavirus, he wanted to kiss everybody. There was little social distancing at the rally, but some spectators did wear masks. Meanwhile, Joe Biden says he's not a fan of expanding the Supreme Court. It's his clearest answer on the issue yet. After weeks of dodging the question, Biden was speaking in an interview in Cincinnati. The idea of adding seats to the Supreme Court has gained traction among Democrats. Many are angry that Republicans are rushing through the confirmation of Amy Coney Barrett. Coronavirus infections are soaring in several Republican strongholds and in the key swing state of Wisconsin. 3 weeks before the election, the hardest hit states are now North Dakota, South Dakota, Montana, Wisconsin, and Utah. Hospitalizations are also on the rise in all 5 states. And hedge fund billionaire Ray Dalio says that China has the advantage over the U.S. on a range of issues. The founder of Bridgewater Associates spoke at the Milken Institute Global Conference.
Time is on China's side and it's not on the United States' side for various developments. So I think what's going to be a difficult situation in the new administration is destiny is on the side of China growing and doing better probably.
Dalio says that one of China's advantages is having higher interest rates. That means it's in a better position of not having to print money. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, Tom.
Leanne, thank you so much. Now, coming up, we have a good conversation on the recovery efforts, and of course, we look at the transformation of the economy because of COVID-19. Later, we host a panel done in conjunction with the IMF and the World Bank. Speakers will be the IMF MD, the former Bank of England governor, and of course, BlackRock Chairman and Chief Executive Larry Fink. You can watch it on the Bloomberg terminal at Live Go or else on Bloomberg TV. That's at 1 p.m. New York time, 6 p.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juicy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
morning, everyone. Bloomberg Surveillance. Francine Lacroix and Tom Keene as we dive into earnings season right now. A lot going on. Futures at -8, Dow futures at -172. Right now, to get out front of bank earnings, Sonali Basak joins us, our chief Wall Street correspondent. I almost put you in Washington, Sonali. I apologize for that.
Thing.
Our chief Wall Street correspondent. Sonali, let me cut to the chase. Beginning of the year, Apple up 70%. S&P up single digits, and JP Morgan is the best performer, down ugly, and everything else down ugly as well. What's the sweat in the corporate boardroom and the sweat in the C-class officer room to turn this thing around? Going into earnings season, what's the urgency?
Listen, Tom, I think you started to hit the nail on the head here. JP Morgan now down more than 20%, more than 25%, really. And you see it in the stock price. You see it in the banks trading at its widest discount to the S&P in a decade, at least. And you see it in Jamie Dimon making the most dire predictions for the U.S. economy than we've seen him make in a decade.
Are they going to restructure? Are they going to lay off tons and tons of bodies? Are they going to just keep it going? Are they going to do a McKinsey 3-year view? What's the angle that they're going to take coming out of this pandemic and where they are right now?
Are you talking a year down the road from now? Because there's a lot of uncertainty here. You have Fitch Ratings expecting loan loss provisions to go into 2021. And the Federal Reserve has already put a clamp down on capital return plans from the banks. You've heard Jamie Dimon say he would love to pursue a deal somewhat like Morgan Stanley had done. He's saying, my line is open, call me. But at the same time, it's kind of hard to do when you're asked to preserve so much capital because loan losses are still rising.
Sonali, how much of it will be, the focus on M&A and some of the revenue that we see, for example, in, IPOs and things like that, and how much of the conversation will simply on when the workforce will go back to the office?
Listen, I think both of you definitely want to see a deal, almost like we did in 2008, where Jamie Dimon said, let's take advantage of the situation and get bigger at this time. But remember, in the next couple of months, situations have gotten worse. We expected the loan losses to really be the end of the story from the second quarter, but we're going to see another potentially $2 billion worth of loan losses from JP Morgan today. So the immediate eye on the prize here is that Jamie Dimon is going to be setting the tone for the rest of Wall Street today on how bad things can get over the next 8 months before they can make grand plans about the future.
So, Sonali, will we be able to see through these earnings also the state of the consumer in the U.S.?
Absolutely, because most of these charges had come from credit cards. And JP Morgan, as we know, is one of the biggest companies in the U.S. They've been playing offense on that respect, but at the same time, if we see more losses on that front at the time when stimulus is also rolling off, it's hard to tell whether we'll see a lot more pain into next year and how that'll impact JP Morgan.
If you're joining us worldwide, Francine Lacroix and Tom Keene with Sonali Basak, Ken Leon on the watch well at CFRA here as we wait for Mr. Dimon to trot out earnings. According to the surveillance watch, they're 1 minute 44 seconds late. It's a scandal. Sonali, was there a bidding war for Eaton Vance? I mean, what's going on here? There's not only so many jewels out there, whether it's banking or asset management. Was there a bidding war?
We all know that James Gorman paid a lot for the asset. You and I have talked about it. He himself said he paid a lot for the asset. And so you're right. There's not a lot of assets out there. I'd say Morgan Stanley needed it, but more than everybody else. When you look at JP Morgan, their asset manager is more than $2.4 trillion in assets. That makes it one of the top 5 players worldwide. So Morgan Stanley needed it, so they were going to pay for it. But whether JP Morgan makes a deal, remember, they can't go off and buy a bank, right? So that's the difference there, Tom.
And they're out with earnings right now. We're beginning to dice through this. Return on common equity, rather, 15%. Return on tangible common equity is a moldy 19%. I'm kidding. That's a very good number. Assets under management, you can compare that to BlackRock with that huge $7 trillion number. JP Morgan, $2.6 trillion as well. I'm just now, Francine, pick it up with what you see, because I'm just getting in the supplements right now.
Yeah, I'm just looking at everything, Tom, and it's pretty much a beat on earnings per share, adjusted revenue. If you look at the investment banking fees, they're also bigger than expected. The one thing I'm seeing is that the provision is bigger for the third quarter for the credit losses. Actually, no, that credit loss provision is 611 million instead of the estimated 2.3 billion. So actually, it also seems encouraging on that front. Sonali, when you look at some of the things that we've been seeing, JP Morgan losing 27% in 2020, are they just crushing the competition?
Yes. Short answer is yes, because they've been able to show that they've been able to preserve capital and find a way to grow even in a hard time. Remember, it's not unlike the financial crisis where we see them leaning on non-consumer businesses. We see them leaning on investment banking, and guess what? They've beat again on that regard. We see them blowing through their competitors when it comes to a lot of those businesses. But again, we have Goldman Sachs tomorrow and Morgan Stanley the next day, which are looking to punch above their weight in those businesses.
Sonali Basak, thank you so much. With much more to come to the week. Right now, Kenneth Leon joins us with CFRA, their Global Director of Equity Research. Ken, I'm just looking now at the propaganda from JP Morgan, and I should point out all the banks do this differently, and I really got to give JP Morgan credit. I love this statistic, Ken. This really says it all for the pandemic. Active mobile customers up 10%. It is about digital technology, that path forward out 5 years, isn't it?
So digital is the way for banking, for customers to save, spend, and also invest. And to the other conversation, JP Morgan wants to be a bigger player in wealth management. But digitalization gets to your other point of the conversation, where they can cut costs as it relates to too many branches, too many employees. Should we not see a stronger recovery?
The language here is, of course, centered around the pandemic and how their employees are adapting to it, the usual that you would see. But Ken, what is the distinction that you're trying to see from this financial leader? What is the JP Morgan item that is of import in this earnings release?
So JP Morgan is a global bank, investment bank, but there's a seawall where it still has a large commercial lending presence and consumer. That means that if we don't see higher lending volumes over the next 12 months, then costs are too high. It's really simple. We have a low rate environment. The yield curve is not favorable to make money. So you have to get volume to offset lower rates. And the consumer side, without fiscal stimulus, as mentioned, it's going to be hard. The long tail, though, Tom, I think is commercial real estate, on the ripple effect for office and residential if we have a prolonged recession.
Ken, I'm actually really surprised. I read it 3 times, and it's also on our live blog. The bank reported a 611 million in loan loss provision. Analysts had expected a $2.4 billion figure. I mean, what's happening with this?
They loaded up aggressively in the first half, $32 billion, which are now in loan reserves. I think it's a wait and see right here. I think the market, the investors looking at this as an opportunity to buy the stock might be seeing that this might be an inflection point where they're fully reserved. And then in terms of reported or book earnings next year, possibly they may have over-reserved. That's the optimistic scenario. Right. The pessimistic one is there's still a large bank tied to loans, and we have to see higher volumes.
Is it going to be difficult for JP Morgan to do much better than this?
A lot, again, is going to happen in terms of the operating business. And clearly here, I think the consumer side, it's really going to be on employment and the ability to pay credit card debt. These are important areas for JP Morgan and other commercial banks.
Ken Leon, I think of Charles Peabody and others on the sell side, your evil science, who are trying to game out use of cash. Now, they have a suspended share buyback right now. Mr. Diamond has that buried in the notes here as well. The long JP Morgan call right now must assume that someday they will have dividend increase and share buyback activation. Do they have the substantial cash flow now where you can guesstimate that will occur out 1 year or 2 years?
The answer is absolutely yes. And I think Jamie Dimon is very frustrated because they have excessive capital. The Fed is telling them that you cannot raise the dividend, nor can you buy back stock until we come back with the COVID stress tests at the end of the year.
Yeah.
This is great for Morgan Stanley and Goldman Sachs because they have a very different profile than a bank that mostly lends. And that's why Morgan Stanley was aggressive buying Eaton Vance.
I want to, this is really important, Ken. I want to go to the financial statement off the Bloomberg now for this small startup shop. We're looking at net revenues of $116 gajillion dollars, an operating margin of 35% plus as well. I'm rounding this all conservative, Ken, and massive double-digit capital ratios. Why aren't they allowed to buy back shares?
So I think from the Fed's perspective that they're, like other large banks, part of risk prevention for any systemic problem that we may have under a adverse stress scenario out there. So it all comes back to the Fed. The Fed is very concerned about the outlook, whether it's L-shaped or U-shaped, and whether we don't see really strong continued recovery until the late part of 2021. The Fed has a more pessimistic view. Chairman Powell has said that he feels we need fiscal stimulus, and that supports the consumer banking of JP Morgan big time.
Ken, what's one question that you'd ask Jamie Dimon right now?
I think the one question is, where do you think there's opportunities to grow, given you have so much capital, or this is just an outsized opportunity of return of capital to shareholders?
All right, Ken, thank you so much. Ken Leon there from the CFRA and Bloomberg's Sonali Bazik, both joining us as JP Morgan, that third quarter adjusted revenue beating estimates, also in terms of loan loss provisions, actually much smaller than analysts had expected. So we'll have plenty more, of course, on the banking sector. Tom, two things the markets are watching out for. A lot of news. We have a lot of companies coming out with earnings, so it will be on earnings watch. The other one, of course, is J&J saying they had to halt their vaccine trial because a patient was ill. So it's, you know, the market grappling with these two things that we'll see where we end up with at the end of the session.
Yeah, again, I think the biggest exercise here for the banks, and this is something Sonali Bazik talks about all the time, we forget how big they are. JP Morgan clocks $117 gajillion. That's $320 million, Francine, every day. I think I got the zeros right. Every single day. They bring it in.
And Tom, they dwarf really some of their competitors, and certainly, you know, they're so much bigger than some of the banks here in Europe.
Yeah, it's just absolutely huge. Francine?
Yeah, we'll have plenty more, of course, on this. It's also IMF World Bank Week, so we'll bring you some great exclusive interviews. Join Tom Keene, Jonathan Farrow, and Lisa Abramovitz next for Bloomberg Surveillance Simulcast this time. This is Bloomberg.
things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
sooner we get the stimulus, the more momentum we can keep in economic recovery.
I think we're going to be stunned by the degree of earnings upgrades.
The risk of the market is the economy accelerates too quickly.
The numbers this year don't really tell us as much as we need to know about the future.
We're still in the greatest economic shock in over 50 years.
The market will hear what it wants to hear, and right now, this market wants to go higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. With equity futures negative 10 points on the S&P 500. JP Morgan, Tom Keene, advancing 1/3%, 3 weeks away from the election. Q3 earnings begin.
Well, it's all into one big pot, isn't it? Incredible news flow here, and we've got the politics we'll talk about as well. But I really do, John, want to talk about the resiliency of American corporations to adapt and adjust, whether it was Johnson & Johnson a bit ago, the $7 gajillion at BlackRock, solid double-digit growth there. And with JP Morgan, John, it's real simple. The gloom of the pandemic, commercial real estate, loan write-downs, we know the story, versus the executable excellence we're seeing in other statistics. I mean, it's going to be fascinating.
It might be too early to say the gloom of pandemic is behind us, Tom, but I think it is time that we talk about the provision build at these banks, and maybe the bulk of that really is behind us. The expectation from analysts was $2.5 billion. The number comes in at $611 million. Tom, I think that's the positive out of this earnings report this morning.
Ken Leon talked about that with CFRA moments ago. Sonali Basak really talked about, that being a key statistic, and it's better than good. But I go back again, John, as I mentioned 10 minutes ago, the idea that they've suspended share buyback, and yet they've got ginormous free cash flow available for dividend growth, and maybe some share repurchase. Granted, you've got the mystery of what commercial real estate's going to do.
Well, I imagine that capital return program will change drastically in about 12 months' time, Tom, when the Fed loosens things up as well. Got to move beyond the pandemic before that happens. Looking at this market right now, up about 1% on JP Morgan. Lisa Abramowitz, in about an hour, another bank drops.
Citigroup third quarter earnings we're going to be getting, and very much, John, to follow on to what you were talking about, the focus really will be on credit provisioning. Will they also come in with a much lighter provision for loan losses than people were expecting and than what they've set aside in the previous quarters? The question, have we seen the worst? And banks on the front lines seeing a recovery that seems to be accelerating. Then 8:30 a.m. we'll get U.S. CPI, Consumer Price Index data for the month of September. The expectation is for a moderation. Food price inflation, car inflation is expected to moderate. Rents are expected to come down. So not that much of an inflationary pressure there. Although if you are looking for inflationary pressure, 1 p.m., Apple is revealing its new iPhones at a product launch. Tom Keene, I'm sure, is very excited to wait online and get all of the new gizmos and gadgets. And I will just say this $2 trillion company really matters for the entire economy in the United States, as well as for the stock market. John, yesterday, the shares gained more than 6%. Today, they're up nearly 2%. Why?
I'm looking for an entry point. John,
Apple.
John, let me make this clear, and I think Dan Ives has been absolutely brilliant on this, and I'm not doing buy, hold, sell here. I'm not a fanboy, and it's going to be interesting to see these meetings that come out. I'm bored stiff by them, John, as I know you are. Guess what? This is a big rollout. This is the first time in 3 years a major redo of basically their core product.
Dan Ives of Wedbush has been talking up this one big time through much of 2020. I have to say through much of 2019 for some of these analysts as well. Tom Keen's about to get much, much poorer, and you'll hear about it through the rest of this year.
It is just a total scam. Everybody out there knows this. Cash flow called up yesterday and says he needs one. You know, I mean, it's just, it's
Apparently
a scam.
the edge of the phone's going to change, Tom. Apparently they'll have sharper edges and they won't be so smooth. That's going to be the big difference.
Really?
That's the
For
only
look
difference.
And feel of the phone. For the look and feel
Different
of
color.
the phone. Might not smash as easily, we hope. That's the wrap from me.
That's
Get to the
that's,
markets.
John,
Futures
that's-
are negative.
That's
by
if you
about
could get in a
1/4%
pub to have a beer.
on the S&P 500. We'll talk about that later, Tom. It's actually quite important, not for me personally, but for people that live in Liverpool right now. Down 8 points on the S&P 500, down about 1/4% on the S&P. And the FX market, bit of dollar strength here. Euro dollar down to 117.93. Treasury market getting back to work, wondering what the juveniles were up to in the equity market yesterday when the bond market was away. Yields come in, a couple of basis points. Your 10-year, 0.7538%. The move of this market yesterday, just absolutely remarkable. Big tech making a massive comeback after underperforming small caps big time through much of October. Joining us now is Jim Paulson, Luthold Group Chief Investment Strategist. Jim, I'd love to get your thoughts on the banks, but let's just begin with the mega move going into the close yesterday, coming into today. Your thoughts on what's going on with big tech?
Well, I think, I think that they've been underperforming here for a little while as the cyclicals and smalls had a rally. So I think some of it is buying the dip. I think also some of it is just some concern on the cyclical story. So you have the stimulus story that continues to be disappointing, and you have the increase in virus cases, which is thinking maybe consumers stay home more. So you kind of had a push back to stay-home stocks, and a lot of people that maybe were getting buying cyclicals, looking at cheaper tech again, kind of buying up those on the dip. I think overall, but at the end of the day, I really think, John, that the biggest thing is that tech just continues to put up numbers, that of growth that is hard to ignore, and I think that's more the driving force than anything else.
The NASDAQ 100 up here, we're up 90, green on the screen with the NASDAQ again. We'll see how that opens up. Not as much as an hour ago. Jim Paulson, what I think is absolutely fascinating here is the wall of worry. One of the key attributes of we're up because of this, up this, is Ben Laidler. Tower Hudson's been great. Nobody loves this market. From Minneapolis, do you see the same thing? No one loves this market?
I do, Tom. I just think this whole crisis has been one of the most emotional we've ever had, and I think that it's really helped the market. It's kept $4.5 trillion in the sidelines in money market mutual funds. People keep flying into the bond market, even though the yields are ridiculously low, and they're coming out of the stock market, which means there's a lot of dry powder on the sidelines if we can ever build some optimism here in the future. We talked about the revisions or the provisions of the banking industry. I was looking at that yesterday on Bloomberg, and total provisions for loans and losses are as high right now as they were in the entirety of the 2009 crisis. So there's a lot of nightmarish scenarios booked into things, and if it turns out that the reality is a little better than your nightmare, then I think there's a lot of revision that has to go on, and that revision will be a very positive force for the markets and for the economy.
So I just want to hook into some of the words, the phrases that we've been talking about. Buying the dip, the wall of worry, nightmarish scenarios. I'm looking at an S&P up more than 11% year to date. I'm looking at an increasing number of money managers saying this is the beginning of a new bull market. I'm wondering where the pessimism is. I mean, basically, are we seeing the end of a default cycle that never happened, and people just basically looking to the banks to confirm that with the credit loss provisions that are lower than expected?
Well, I think that I think you look at gold at a 50-year high, Lisa, to other commodity prices. There's a lot of people that have plowed into gold, and money market funds. Look at the ratio of S&P low vol index to the S&P High Vol Index, it remains at extraordinarily high levels relative to 1990. You even had, look at the move in utility stocks that you've had here recently overall. There's still, to me, a lot of bearish investment behaviors going on. And then there's things like the American Association of the Investment, bulls less bears ratio. So I think there's quite a bit of evidence of climbing a wall of worry right now.
I love the idea that this bearish behavior is going on with the world's, or the biggest company in the US market right now, up about 6% in yesterday's session, Jim, seemingly on nothing. I mean, the launch of a new iPhone, we knew that was happening today. Don't you find that remarkable, Jim, that a company that big moves that much on nothing?
Well, I tell you, I've been impressed, John, when you look at, when I look at the market, there's 25% of the highest PE stocks have moved into a new valuation range over the last 30 years. The lowest 75% PE stocks have stayed in the same valuation range they've been in over the post-war era. But then when I look at 25% of the stocks out there have had rates of return on equity that were in one range up through about 1990 and have gone into much higher ranges since, persistently, while the rest of the stock market, 75% of the other companies, haven't seen that. So my point is that highest part of valuation in the stock market, mainly made up by new era technology and comms, they're justifying their performance with excessively good fundamental performance. And I think that continues to be the case. With the products that Apple comes out with, you just cannot really get that in 75 to 80% of the rest of the companies in the world. And I think that growth against an economy which is growing very slowly, 2 to 3% for a decade or more, is just outstanding and probably worth a lot more valuation.
Can't get those margins either. Jim, great to catch up, sir. As always, Jim Paulson of the Luthold Group, thank you very much. Futures, negative about 0.1%. JP Morgan is positive a little more than 1% of the pre-market. As Lisa points out, in about 50 minutes' time, we'll get earnings from Citi. Tom Keene, one thing that's not talked about enough is the outperformance of small caps through this month so far. I'll give you the numbers. The Russell, up by almost 9.5%. This month alone, Tom. We're halfway through it. The NASDAQ getting all the fanfare in the last 24 hours, up around about 5 or 6. But the real outperformance has been in the small caps in America.
This is a wicked important idea, John, that you've just gone to. Is the basic zeitgeist is tech up or tech not up, or small cap international up or not up? John, what if they both went up? Nobody's talking about that framework. Maybe there's a few Uber bulls, Ben Laidler, and a few others that are talking about it. But what if we get tech sustain and goes up? And what if we also get, as you mentioned, John, that small cap goes up as well?
Mike Wilson of Morgan Stanley's been looking for this rally to broaden out.
Yeah.
And I'm not sure if he's one of those names you throw into that hat, Tom, but he's certainly one who's looking for that equity market rally to broaden out.
I mean, you're so gloomy. You're quoting SPX, you're quoting JP Morgan. Look at the NASDAQ 100 minis. I mean, come on, look at the move this morning.
We're at 1%. I see it. I'm with you.
0.96%. We go to 2 digits on
Just
Wednesday.
to get a broader picture of the market,
Tuesday.
Tom. The S&P 500, down a tenth. The
You
NASDAQ,
are so
flying.
so
Are you happy
powerful.
now?
You're powerful.
Are you happy now? Do I sound gloomy? Too much time with Lisa.
Hey.
It's
Come on,
true.
Lisa.
I'm not
You
gloomy.
nailed it.
Happy Tuesday.
This is Bloomberg.
With the First Word News, I'm Kaylee Lyons. President Trump says he feels so powerful after recovering from coronavirus, he wants to walk into a crowd and kiss everybody. The president spoke at a rally in Florida, his first stop following his return to the campaign trail. There was little social distancing at the event, although some spectators did wear masks. Supreme Court nominee Amy Coney Barrett faces questions on the second day of her Senate confirmation hearing. One of her questioners will be Democratic vice presidential candidate Kamala Harris. Yesterday's hearing wrapped up with Barrett's opening statement. She outlined her experience and spoke of the role of the judiciary. Johnson & Johnson has temporarily halted its coronavirus vaccine study. That's because a clinical trial participant experienced an unexplained illness. The illness is being evaluated. The same thing happened last month involving AstraZeneca's vaccine. That study has resumed in a number of countries, but remains halted in the U.S. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic?
Okay, I'm placing in order to stop position and sell at on euro, as you can see, and sell it at 117.91.7. Okay, stop placed. So if it will go back and reach this level, we'll sell this position.
Get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is another side effect of these ultra-low interest rates and aggressive interventions, particularly in corporate debt markets, is that it's really supporting M&A activity. It's supporting further concentration, including in the financial sector.
Former FDIC Chair Sheila Bair there, wagging on the financial sector, very much a focus this morning. JP Morgan numbers behind us, Citi just ahead of us. From New York and London this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 2 hours away from the opening bell, plus 12 minutes. Here's the price action this morning. Tom Keene complaining 8 minutes into the programme. Equity futures negative on the S&P 500. There it is, Tom, for you. Big tech outperforming. Is this just to make you feel bad because you didn't participate? NASDAQ futures at 115.
I'm looking for an
up
entry
around
point.
about 1 percentage point.
I told Ben Laidler, called Ben Laidler up last night in London. He was in a bar watching
What
it
did he
close
say?
at 10 p.m. I said, Ben, where's my entry point? And he said 2030.
He said, don't call me.
Don't call me. Yeah.
This might be the Q4 mount up. Lisa, let me tell you, that's what I say every time he calls.
Oh, I
He's
have no
still
doubt.
calling.
But, you know, what I think is so important here, John, is to look at Apple today with a further lift with the NASDAQ 100, as you mentioned, up now a full 1%. We're up about 8% since the beginning of the month on Apple. And I believe at the beginning of the month, we were all gloomy, weren't we?
Tom, we're up 1.7% this morning, and yesterday on Apple, we were up 6.35.
Yeah.
Do the math on that. It's ridiculous.
Well, do the math right now, folks. I want to really emphasize this as we go to Allison Williams, Bloomberg Intelligence here, senior analyst on JP Morgan, banks, and all that. We forget the size of these institutions. Take 117 billion divided by 365, and you get a ginormous number of $320 million rung up at the register every single day. Allison Williams, the scope and scale here begins to be international. Buried in the headlines, they're not only going to take on Europe, but they're going to take on new states in America. Is JP Morgan going to be our national bank?
Well, they sort of are. JP Morgan and Bank of America, both significant and growing. Wells Fargo is sort of up there, but they have some constraints that have obviously held them back. And organic deposit growth continues to be a really strong story. To your point, JP Morgan going to be opening branches in more states, so continuing more share gains. But the big story today is really that loan loss provision coming in at $611 million versus expectations for $2.5 billion. And we're seeing reserve releases sort of across most of the units.
Let's sit on that for a second. This idea that the street was expecting JP Morgan to set aside more than $2 billion for soured loans, and yet they only set aside $611 million. John was mentioning this earlier. What is the inference here? Is it that the economy is doing much better? Is it that the loan loss provisions that banks have already set aside are sufficient? How do you read this?
It's probably a combination of that. And so we're obviously going to want to hear more on the call. But if we look at the loan loss provision has two components, right? So one is the actual charge-offs that we're seeing, and then two is the sort of cushion that we're setting aside for future losses. And so the first half, we saw these massive provisions. Most of that was sort of guesstimates in terms of how bad the banks thought they could be. That depends on, you know, sort of their look at their portfolio and also estimates around the economy. We haven't really seen sort of the increasing loan loss trajectory yet, just due to a lot of the government support that we have, obviously. So this quarter, banks have basically said, look, we think that the provisions are kind of going to match the charge-offs. What we're seeing in JP Morgan's actual report is reserve releases. And so they talked about reserve releases related to running down their home mortgage portfolio. So that's residential mortgage, obviously. But when you look at the numbers, they had reserve releases in their commercial unit, in their corporate investment banking unit, still building up in the consumer unit. And so what they said it was across industries. And so what we're going to want to hear about is, are they seeing the sort of the migration in their portfolio that tells them that the experience is not going to be as bad as they expected? Because it doesn't sound like it's a change in the economic assumptions. We already sort of knew that ahead of today. And so that's what we're going to want to get more information about. But it bodes well, and I think we'll sort of see what happens with the other banks, Citigroup, due to report.
I closed position on Euro at 117.91.7.
Seen this morning with the small loan provision bill, and I just wonder what the other names look like, Alison. Is this a JP Morgan story or something more broadly?
Well, and the two things I would point out, so specific to JP Morgan, when we looked at their loan loss reserves last quarter, so one way to figure out how well these banks have sort of done so far is to look at what they've built up versus their overall loan portfolio. And then we sort of take an extra step of comparing that to their provisions in the stress test, which sort of gives us a little bit of understanding in terms of their reserve based on the makeup of the portfolio and their underwriting. And JP Morgan looked great on that measure, so perhaps they were a little bit more conservative. Citigroup will be the interesting one because, as I said, the one area where JP Morgan is building reserves still is in their consumer, or excuse me, at least where it wasn't a major reserve release like the other units, was the consumer unit. Citigroup had actually been a little bit more conservative and expecting more. They have a much bigger card book, which has been sort of the area of worry.
Is JP Morgan's success stealing share from Citigroup?
So perhaps not apples to apples per se. If you think about JP Morgan's footprint, they have sort of a broad branch footprint across the U.S. Citigroup has a very distinct footprint, just focusing on very specific areas. And then by contrast, they have sort of this global branch network around the world, which really only HSBC sort of is similar in that respect. So to some extent, they do have different businesses, but to the fact that JP Morgan, the trading numbers today looked great. They have been gaining trading share globally from all of their competitors, so that's an area. And then just to the extent that they are getting some of these, sort of higher-end customers that Citigroup goes after, gaining share. But within those deposit markets, a lot of that is against perhaps some of the smaller regional competitors.
Alison, great to catch up, as always. Alison Williams there, weighing in on the banks, about 35 minutes away from getting the numbers from Citi. Looking at JP Morgan this morning, up by 1.71%. Citi doing nicely as well. Ahead of those numbers a little bit later. Tom King can't avoid what's going on the screen, though. This rally in NASDAQ futures is something else after the gain of yesterday. We talked about how much the small caps have outperformed through much of October. We're closing the gap quickly based on the evidence of the last 24 hours.
Well, yeah, and it goes, to me, John, it goes back and forth. I mean, there's no other way to put it, and who knows what we'll see today. Well, again, I'm going to go back to this tech up, small cap up. Nobody's looking for that.
Find a price move, find a story. Lisa, what does SoftBank say over at Milken?
Oh, it's not us.
We're not a whale.
We're not a whale. We're not even a dolphin. Not even a dolphin.
We're not even a dolphin. What is that? What is that? From London and New York. Good morning to you all. This Tuesday morning. More banks still to come.
Can we talk
Sitting at the top of the hour. I'd love to, Tom. We could do that next. Right here on Bloomberg Surveillance. There's a tease.
Woo.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From London and New York, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning, 2 hours away from the opening bow. JP Morgan numbers behind us, coming in better than expected. The reserve build smaller than expected. Here's the price action. Equity futures on the S&P 500, negative not even 0.1%. JP Morgan firmer by a little more than 1.6%. But the real story is the outperformance once again in NASDAQ futures, up by 114 on the NASDAQ 100. We advanced 0.9%. That's the equity story. In foreign exchange, euro dollar 117.90, weaker euro by about 0.2%. A big question for this market, for this economy. Are we losing momentum in the recovery? Take a listen to what Paul Donovan of UBS had to say to us.
You've just spent 3 months sat at home watching home makeover shows on Netflix. What are you going to do? You're going to go rush out and spend the money. And that's exactly what happened. And once you've spent the savings, then obviously the momentum slows.
And the momentum is slowing. So is the next stage of the recovery dependent on a fiscal deal? This is what James Sweeney of Credit Suisse, the chief economist there, has to say. Without a successful deal, personal and business bankruptcies are likely to mount, and the whole trajectory of the U.S. recovery is at risk of a lower path, meaning a longer time back to full employment. The path of U.S. household disposable income is an essential variable for further recovery. Tom Keene, where is that deal on Capitol Hill?
Well, you're waiting for the deal is on Capitol Hill, but the duration of this slowdown is extraordinary. And joining us now, Mr. Sweeney of Credit Suisse. James, you've been really good about this. We're in Q4 right now. What does Q1 and Q2 look like if we don't get stimulus?
Well, if we don't get stimulus and we don't have legislative flexibility to get new stimulus, which I think is the mixed result in the election possibility, then I think it's going to be a very difficult recovery. And the rate of decline in the unemployment rate is likely to slow. Business investment isn't going to pick up very sharply, and we're going to be on a lower trajectory than we would otherwise be. I think it's very important that we have a flexible government that can help the economy get back to full employment as quickly as possible.
What is the symbolism of a stock market up, the tech moonshot that we're seeing right now, JP Morgan doing better in earnings? We'll see what the other banks do as well. That good news, James Sweeney, versus the Credit Suisse call of some real caution out there. How do you put those two together?
Well, I mean, even within the economy, you see a lot of conflicting signals. Retail sales on goods have been great. Spending on consumption, on services items has been very weak. Construction investment has been good. Business investment has been bad. The equity market is responding to the strength in retail sales, the strength in technology products, and low interest rates. And until recently was responding to some rising economic data. Now the economic data is slowing.
It strikes me, James, that this is a hard needle to thread for economists who are saying the recovery may still even be intact without additional fiscal support, but it won't be accelerating enough. We won't see a fast enough recovery to avoid longer-term scarring. What do you say to people who argue that there is a cost for incurring more debt in order to pay forward the economic growth, to ameliorate any suffering now? What do you say to say, yes, it's worth it, even though that debt still has cost?
Yeah, well, I mean, in some level, I think all macroeconomic questions are about time horizon. So you could look at it over a few months, you could look at it over very long term. I agree that there are some costs when you build government debt and government liabilities further over the long run. But we know from economic history that in a recession, you don't necessarily return back to your old trend. So, fiscal opportunism is what we need now. With such low rates, such easy financing costs, you have an opportunity to help push the economy back towards its old trend as much as possible. And it is really possible that you never get back to it without adequate support.
So, James, that's worrying because the previous trend was already a worry for people on Capitol Hill. So let's talk about how much damage we could see to potential growth in the future. What kind of numbers are you thinking about?
Well, I mean, we're looking maybe 5 years out. I can imagine GDP growth being a % or 2 below the long-term trend that you might have projected before the pandemic. And then you run trend growth from there. So you're at a permanently lower level. To me, that's just about the worst case scenario for growth.
So that's the worst case. Walk me through the base case, because you mentioned a couple of different forces there. Lower confidence to invest, one. Then you alluded to a demand shock for an extended period of time as well, James. CPI in about 55 minutes. Where does inflation come out from all of that?
Well, I mean, and I would say in the base case, there is a recovery. I mean, even in that worst case, there is a recovery. It's just a recovery that doesn't get you to a very good trajectory. While we are in that recovery, if the economy is not operating at its full potential, then the risks of inflation may be to the downside. But the weird thing is that, it does look like inflation is going to have a little bit of a pop its nose above 2%, next spring, next summer, momentarily, driven by base effects, and then come back down again, maybe after next summer. If the recovery is not adequate, we'll start worrying about very low inflation again. But for now, inflation doesn't look all that much different from its kind of 1.7% average in core terms over the last 25 years.
This is sort of mind-boggling to me, James, that basically we're printing trillions of dollars and we're not seeing any inflation. Is this basically saying that modern monetary theory, that basically the Federal Reserve buying as much as the government has to sell, which seems to be what has happened, seems to be not that inflationary and is fine?
Well, I mean, in the short run, when you're at zero interest rates, bonds are not very attractive over cash. So if someone has a little bit of extra cash, there's not much disincentive to sit on that cash as opposed to go into bonds. So the extra money doesn't necessarily lead to kind of persistent inflationary rocket fuel. But longer term, a government with more liabilities is going to have different fiscal dynamics and different risks. And so I think there is a cost, but there's an opportunity right now to get the economy on a higher trend, and that's what's the most important thing.
James Sweeney, the calendar says it's time to hold panels. It's time to hold seminars with worthies. It's time for institutions to get together and wring their hands about inequality. What has this pandemic done to American inequality?
Well, recessions always worsen inequality. I mean, we know from some attributes of the pandemic itself that does that as well, which is extremely sad. Getting the economy back to full employment is really what policymakers on the fiscal and monetary policy side can do to help inequality. I mean, on the fiscal side, further questions are about redistribution, and those need to be taken up in the Congress if they want.
Now, look, James, at the inequality and the ability to come out of this, what is the size of appropriate stimulus? I asked William Lee of Milken this an hour and a half ago. He was nudging towards $3 trillion. What's a Sweeney number where stimulus actually works?
Well, I mean, I think a $1.5 to $2 trillion stimulus would be large and powerful and would transform the short-term outlook. I think it would help households get another burst of cash flow, keep disposable income above trend. It would also help potentially state and local governments finance themselves, so we won't see large job loss in that sector as we did last month.
Right now, James, when you look at the high-frequency data, there's a question of how much the economy is slowing due to the resurgence of virus. What's your take on that? Do you see a material slowdown in the high-frequency data that has you concerned?
Yes, and especially in Europe, actually, where the increase in the pandemic has been a little more severe. But we saw this also in the summer, and when we looked at high-frequency data, foot traffic, store traffic, things like that, you did see these issues. But in a rising momentum economy, you couldn't feel it. So I got the question, if it was such a problem that you didn't get stimulus in August, why are retail sales so good? And the answer was, well, we're still in the rebound. The rebound that began in May. But the problem is we're not in that initial sharp return to work rebound anymore. So as the data mean revert to normal levels, you're going to feel shocks more. And the pandemic drag on growth that we're starting to see is one of those shocks.
James, great to catch up. As always, James Sweeney there of Credit Suisse. Always tremendous to have him on the programme. In around about 50 minutes' time, CPI in America. Tomorrow, PPI. Thursday, claims. Friday, retail sales in the United States. The big data point of the week, I've got to say, coming at the back end. Looking at this market right now, we shape up as follows. Counting you down to the opening bell in New York this Tuesday morning. Big lift for NASDAQ futures. NASDAQ 100. E-minis, Tom, up about 108. We advanced 0.9%, off session highs, but a decent bid after a massive rally yesterday. So that's the price action. We've got to talk about the politics this morning as well. Tom, the president, back on a campaign trail, on to Pennsylvania, I believe, today, Iowa tomorrow, then on to North Carolina.
And you wonder what Mr. Biden will be doing as well. It's just there was a little more Biden in the papers today than the shocking dearth of Biden yesterday. But it's interesting, John, I've never seen a polar opposite of the two campaigns that you see right now. Never seen it.
Well, let's talk about the polls. We'll discuss them with Kevin Cirilli in just a moment. This from Siena College, New York Times, in the last 24 hours, Tom. 8-point lead in Michigan for the former Vice President Joe Biden. 10-point lead in Wisconsin for the former Vice President Joe Biden. And for whatever these polls are worth, Tom, I understand you don't buy it, but these are states that the president flipped and beat Hillary Clinton in by a very narrow margin. And they are decent leads at those state-level polls.
I'll give you a Biden lead, whatever the math is, whatever the pros tell us. But any time in America this close, this divided, you see a 10% separation. I have 10 points. I really have trouble with that, John. I defer to Mr. Cirilli on this because he's so powerful.
We will defer to Kevin in just a moment. Lisa, it's 3 weeks away. I'm not sure how powerful Kevin Cirilli is. But I think most people just assume in even this market, given where we were, a month ago, where if you asked people whether a blue wave, whether it was bullish or bearish, I think many people might have said it was bearish. And now almost exclusively, universally, everyone lining up to tell us how bullish it is.
Because it means we're going to get a huge fiscal support bill and the economy will keep on chugging. There is an interesting little, disagreement here among analysts you can start seeing emerge. What happens if Democrats don't win the Senate? And that could be a huge bear situation for the market that people are looking at, because that would mean gridlock. It would mean it would deter any additional fiscal round. So that's something to really watch, the Senate races, particularly for market reaction, John.
Lisa, I agree. But on the morning of November 4th, whatever the price action is doing, they'll come up with a new line.
Absolutely.
Let's just say the Senate stayed Republican. Then they'd be saying, this is good news. Tom, this is great news. Because Senator Harris told us on day one we'd undo the Trump tax cuts, and now they won't be doing that anymore. There's always a story to spin as to why stocks are up.
It's what keeps us busy on radio and television.
Telling stories.
It's good fun, isn't it?
I'm looking for an entry point. Let me know when you see one.
Down 3 on the S&P. Up big time on NASDAQ 100 futures. Up a little bit later in the next hour. Catherine Mann of Citigroup, the chief economist. Looking forward to that chat. A little bit later right here on Bloomberg.
With the First Word News, I'm Kaylee Lyons. President Trump is diving right back into campaigning. He told an audience in Florida he felt so powerful after recovering from the coronavirus, he wanted to kiss everybody. There was little social distancing at the rally at the Orlando Sanford International Airport. Some spectators did wear masks. Joe Biden says he's not a fan of expanding the Supreme Court. It's his clearest answer on the issue yet after weeks of dodging the question. Biden was speaking in an interview in Cincinnati. The idea of adding seats to the Supreme Court has gained traction among Democrats. Many are angry that Republicans are rushing through the confirmation of Amy Coney Barrett. Coronavirus infections are soaring in several Republican strongholds and in the key swing state, Wisconsin. 3 weeks before the election, the hardest hit states are now North Dakota, South Dakota, Montana, Wisconsin, and Utah. Hospitalizations are also on the rise in all 5 states. A shakeup at Disney, the world's largest entertainment company, is revamping its operations to focus on the thriving Disney Plus business. The goal is to become a global streaming giant like Netflix. Disney is putting its TV channels, film studio, and direct-to-consumer divisions inside one big group. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York and London, good morning to you all. This is Bloomberg Surveillance Live for our audience worldwide on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, counting you down to the opening bell. We're set up as follows, with equity futures advancing on the Nasdaq big time, up 0.9%, adding some weight to the rally of yesterday. On the S&P 500, just a little move lower. We shave about 4 points off the S&P. We're down a little more than 0.1%. JP Morgan still firmer in the pre-market, up by around about 1 percentage point. Provisions smaller than expected, numbers better than expected. Citi reporting in 12 minutes time, Tom. That'll be the story for the banks at the top of the app.
For those not sophisticated on this, I really want to emphasize each bank is different. And John, I think it's going to be fascinating to see Diamond, JP Morgan, and Corbat's legacy at Citigroup, to see the difference there. I mean, the conference calls alone, John, will be completely different tone.
Yeah, the succession planning with Citi, there'll actually be a conversation there. You know the story on JP Morgan. If Jamie Dimon's asked, Tom, 5 more years is often the answer. It is a rolling 5 years.
It's been a rolling
with the man
5
at
years.
the top of JP Morgan for the last 10 years.
Oh, yeah, at least, I would say. Right now, let's go to the rolling 4 years, which is called the presidential election. Kevin Cirilli joins us, our chief Washington correspondent. Kevin, a general question here. I don't want to get into polls and all that, and I know you're exhausted from the day-to-day. Who is the silent majority now? You don't remember Spiro Agnew. I do. There's a silent vote out there somewhere. Identify that silent vote right now, Mr. Cirilli.
You know, go to Center County, Pennsylvania, and on the outskirts of central Pennsylvania, right where it's Pennsyltucky, so to speak, as James Carville famously called it many years ago. And look, I think that those individuals who are looking at the economy and looking at what they feel are some elite members of the cities, you know, will they show up for the polls for President Trump? And you know, I'm really struck by just how the Republican machine in operation is not trying to make a coalition, but trying to amplify not trying to do a traditional coalition, but trying to amplify conservatives to show up to the polls.
What's the Democratic machine doing to get their silent vote out?
They're trying two things: to keep those spreads down in traditionally conservative districts and to run up the score in suburbs. They feel, I mean, the Republicans aren't even trying to win at this point, the suburbs. They're just trying to keep the margins of victory for the Democrats significantly down, right? But in terms of, I think, case in point, what you saw yesterday with Democratic presidential nominee Joe Biden saying that he is not a fan of packing the Supreme Court was a clear calculation to try to win over suburban voters and a firm assertion that he feels that he's got the base of the party secured.
Well, female suburban voters with a massive lead towards the former VP, Joe Biden, Kevin. Pick a poll, any poll right now, and it doesn't look good for the President of the United States. Reuters Ipsos, this poll for Wisconsin and Pennsylvania, 7 percentage point lead. But the one thing that comes up again and again and again on the campaign trail is this idea of new voter registrations in key states for the Republican Party. Kevin, can you walk us through that argument?
You know, I remember over the summer speaking with Ronna Romney McDaniel, the chairwoman of the Republican Party, and behind the scenes, her staff had been telling me for quite some time that they feel this is an area where Republicans have been able to make up solid ground and to outpace their voter registration from what they saw in 2016 levels. They view that as a sign and an illustration that President Trump has been able to attract new members to the party, members that have been disenfranchised with Republican politics for quite some time, and that Democrats had not made a case for. You know, so it will be really interesting to see if those voters show up to the polls on Election Day.
There's also a question about Del Boca Vista Club. Basically, if you go to Florida, the seniors there are going to have a very big effect on this election. How big of an impact could the Del Boca Vista Club have?
Well, you know, I think that's a great point. And when you look at this spread right now in Florida, according to a New York Times Siena poll that came out yesterday, it's a 3.7 percentage point spread in Florida. The president's still within the margin of error there. But Democrats are really being able to make up ground, especially on the issue of senior citizens. About 2 weeks ago, President Trump made new claims that he would provide free health care for senior citizens and that they would essentially be getting a check. Now, to be honest, there hasn't been a substantial policy proposal that have been put forth after that. But it's clearly a sign that the president and his campaign are trying to make inroads with seniors. They had made the calculation that senior citizens and the response to COVID-19 would be a local issue. But in a state like Florida, Republicans are in control there, in contrast to a state like New York.
What's the Latino update in Florida? I mean, there's other states as well, Kevin. I don't mean to not focus on them, but is it 26 electoral votes in Florida? What's the Latino Hispanic update, Cuban update?
Well, especially with regards to the Hispanic vote in a state like Florida, you've got Cuban Americans who have been traditionally leaning more Republican, a strong percentage of them with Catholic religious ties, and especially you look at the Hispanic vote in Florida, and you have to factor in foreign policy issues like Venezuela, for example, and on the notion of Cuba, and that's been an area where the president has been able to outperform even Mitt Romney levels from several cycles ago. And so they feel confident in that. But again, it's those suburbs that have been breaking for Biden that have them that spell a lot of political trouble for them.
Kevin, just quickly, a couple of months ago, October 15th, was in red ink in many diaries down in Washington, D.C. Is that over? It's not happening? No debate?
Yeah, I mean, I think that's a fair assessment.
I think. Sensed a little bit of doubt there, Kevin. Kevin's already there, Bloomberg chief Washington correspondent. Tom, you would have thought that would be the date in the diary for the president to really turn things around. That's when the polls started to go south on him. Straight after that debate and going into that crushing weekend for him when he tested positive for COVID-19.
Well, there's a lot of that, and the hoarseness mentioned yesterday within the media. Just you wonder, John, I'm going to be honest, you just wonder day 2, day 3, day 4, the grind. I mean, everybody ends up where they can't speak at the end of one of these elections. I mean, that's always the case. You can barely talk. You're so exhausted. But this is a president recovering from this illness. John, one thing on J.P. Morgan Citigroup I want to talk about. I just went back and did a highfalutin math study of J.P. Morgan compared to Citigroup, and it is what's called a 3 standard deviation delta. All you got to know is it's stunning, the outperformance of J.P. Morgan versus Citigroup back a decade.
Oh, and the stock price is absolutely phenomenal, Tom, and we can talk about the chart
like
a little bit later.
Like how I got the delta
also
in there? It's a great,
I love that. Every time you do that.
We're gamma, gamma
delta. Turn up for work for every morning.
Stay around,
Tom,
Alpha.
Look, Lisa just sounds so excited about all of it. Those numbers coming in about 5 minutes' time. Citigroup numbers just around the corner. JP Morgan firmer in a pre-market, up by a little more than 1%. From London and New York this morning, good morning. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Coming up very shortly on this equity market, with big tech outperforming in the last 24 hours, Christopher Harvey, Wells Fargo Securities head of equity strategy, with the S&P 500 down 0.2. The Nasdaq absolutely flying. Up next, earnings from Citigroup. This is Bloomberg Surveillance.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en unas en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Sooner we get the stimulus, the more momentum we can keep in economic recovery.
I think we're going to be stunned by the degree of earnings upgrades.
The risk of the market is the economy accelerates too quickly.
The numbers this year don't really tell us as much as we need to know about the future.
We're still in the greatest economic shock in over 50 years.
The market will hear what it wants to hear, and right now, this market wants to go higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television worldwide. A number of stories, including 21 days to the election, both campaigns gearing it up and fine-tuning. We're distracted by bank earnings. John Farrow, J.P. Morgan, doing better than good. And right now, I'm getting the dump of a compare 140 versus 92 cents on Citigroup. So at least Citigroup on first blush giving us the same enthusiasm we heard from J.P. Morgan.
Jamie Dimon, JP Morgan delivering a beat, and it looks like Citi repeating the act. Fixed sales and trading revenue coming in just short of $3.8 billion. The estimate $3.66. As you point out, Tom, the EPS figure, third quarter, $1.40. So a little bit of an upside surprise here. I believe we have Bloomberg's Shonali Basak with us as well, our Wall Street correspondent. Shonali, what are you seeing?
We're seeing a beat on revenue. We're seeing a beat on net income. We're seeing a beat in fixed income trading here. We are seeing loan losses, the provisioning that is higher than what JP Morgan had put in, but again, lower than what analysts expected. So perhaps Wall Street has just gotten it wrong compared to what the banks are expecting in terms of loan losses. Again, they are higher than JP Morgan, so we're going to want to understand why the divergence. But overall, pretty clean numbers here by Citigroup.
Shonali, as we see the numbers come out, we're getting this, folks, right now in real time. Every bank brings them out differently. And JP Morgan, I'm going to be blunt, there I finally just now have gotten the research done from Citigroup, and we'll see what that looks like. But Shonali, is this Mr. Corbett's bank, or they moved on to new management with this release?
They're moving on pretty soon. Mr. Corbett will be around through the end of the year, but we'll see Jane Fraser take over next year. You know, you were talking about Citigroup stock price earlier, more than 46% down on the year. There's succession questions questions here as we move to a new guard. Remember, there's already been a lot of change at the top, but there's also questions around regulatory issues.
And we've got, Lisa, the return on equity, 6.7%, shows some of those challenges. Return on tangible common equity as well, 7.9%. These are numbers, Lisa, starkly different from the double-digit excellence of JP Morgan.
Yeah, but they're still making money, and they're making quite a bit of it given their size, and yet they cannot return it to shareholders in the form of buying back shares or paying out dividends based on the Fed's new rules. Sonali, what are they going to do with all this money?
They're going to use it to improve their return on equity, at least. I mean, that number there is still pretty low. Again, it is higher than the second quarter. The return on tangible common equity was about 3% at that time, but it's low compared to JP Morgan, which they're competing with.
Mr. Corbat, we continue to navigate the effects of the pandemic extremely well. Credit costs have stabilized. But Sonali, I see it with a headline off paragraph 2 of their release. Revenues decreased 7% from prior year period. And there's a real question here about bringing it down to the bottom line, net income. Sonali, what is the greatest distinction between Citigroup's operational ability to profit versus something as excellent as JP Morgan?
Well, one area they're going to have to contend with is their global reach and the issues that the rest of the world is seeing. One area neither of you guys have talked about yet is net interest income and how much pressure that's putting on these banks. Citigroup does not have the same heft in investment banking that JP Morgan has. So until they get that heft, they don't have the offset. So this net interest income, that's the one place JP Morgan missed expectations, and Citigroup is seeing the pain there as well.
John, lots of discussion. Sonali Basak, thank you so much, our Chief Wall Street correspondent. John, I look at the press release, and it's very classy how it does mention that $400 million fine, which had a lot to do maybe with Mr. Corbat retiring a bit early. John, what do you see there? Anything you notice as well?
I have to say, I always enjoy the quarterly review of earnings releases from you, Tom. Who does it well and who doesn't at all? And you don't hide how you feel about it when these numbers drop.
No, I think it's really, this used to be, folks, this used to be easy.
I agree.
John, for radio and TV back, this is really important. 20 years ago, this was done by smoke signals and semaphore flags. And there was a golden period, John, with Michael Bloomberg and Tom Secunda on the Bloomberg terminal, where this stuff was put out in English, clearly, earnings to earnings, company to company. All that changed like 3 years ago with technology, and now you got to be a cyber expert like Sonali Basak to get anything within 2-3 minutes of the supposed release. It's way harder now. Can I get off my...
Let's make it really simple. You can stop. Take a breath. Let's make it really, really simple. In a word, stabilized. And that was the word that Mike Corbat used on credit losses.
You
and I
want
think
me
that's the word we've got to
stabilized?
use. I'd love to see that for JP Morgan and for Citi as well. That word stabilized, that the provisions for loan losses, Tom, they look built, and it looks like the situation is stabilized. And the numbers are expected to be a lot bigger than they are this morning. And I think that's the positive point from JP into Citi, and for Bank of America later this week. That'll be one to watch too.
And one, John, that we should point out with Citigroup and JP Morgan particularly, in Europe, their platform there as they take on the challenge European banks is really quite something. We'll keep monitoring this again with NASDAQ futures up a solid 92 points, not like it was an hour ago, and of course, futures at -4 right now. Christopher Harvey is with Wells Fargo, head of equity strategy. Chris, if we could move from the banks, or let me start with the banks. I don't want you to comment on Wells Fargo or, frankly, individual stocks. I understand that's important. Do we get a lift of financials along with a small cap lift, or is it still going to be growthiness out there that reigns supreme?
So, Tom, month to date, we've already gotten a lift in small caps. We've already gotten a lift in financials. Next couple days, so far, the numbers look pretty good. So I would think that this is a positive for financials in the short term, but you also have news out of Apple, news out of Amazon, which is helping push those stocks higher. But longer term, we are very positive on small caps. We are positive on cyclicals, and we are positive on what we call higher COVID beta plays, which include the financials. And I think overall, this is rather positive for your credit card companies when we talk about credit and we talk about reserves and provisions. They don't have to deal with the net interest margins that the banks have to.
So a lot of people agree with you, Chris. I know that Morgan Stanley thinks that there's going to be this ongoing rotation into the small caps, into the more value names. So what the heck is going on with the NASDAQ?
Again, you've seen some of the Uber caps really underperform month to date. You have some really positive news or potentially positive news coming out of some of your Uber caps, whether it's Apple or Amazon. And so they're beginning to balance. The other thing is you still have a fair amount of retail money in the marketplace. And those are names that are fairly well known and well loved by the retail names. And let's not forget, yesterday was a holiday, so people may have had a little bit more time to trade their PA.
Are you saying, Chris Harvey, that the bond guys were away, so the equity traders had a little play?
I wouldn't say it like that. You're much more eloquent
Is
than
that,
I am.
are you trying to say the adults were out of the room for a little bit? Is that what you're implying there, Chris? I'm just trying to understand where you were going with that line.
Maybe, possibly. Well, yesterday, a lot of people, I was talking to some friends, and they were saying, I was asking what they were doing. They're like, oh, I'm trading my PA. And so people did have a little bit more time to mess around and maybe push things around a little bit. And the other thing to talk about,
well, let's talk about messing around, Chris. It's a $2 trillion name. It's Apple. The stock was up 6% yesterday. Let's see what it's doing this morning. Come on, it's ridiculous. We're positive again. And are you telling me this is about an iPhone launch that we knew about months ago?
Well, there's a lot going on with Apple, and as we've talked about in the past, Apple is one of the most underowned or underweight names in the institutional buy side, and that has something to do with it. The other thing is they have trailed. We are hearing a lot of positive news. What we think is happening, we had a pretty benign pre-announcement season. We think earnings are going to be better than expected. We think the economy is better than many people expected, and we think there's a turn in sentiment. And let's not forget, let's start looking at first half numbers. First half numbers are pretty low. It's a pretty low bar. And maybe in a month, maybe in 2, maybe in 3, we'll have some sort of COVID solution. I'm sorry, Tom, I cut you off.
No, Chris, this is thrilling. I'm thrilled that you're on. This is really, really, really important. And that's the year-end ballet. You talk about Apple underowned. What else is underowned, and what is the sweat out there of active managers who perhaps have underperformed? It's October, whatever it is, 13th, and the sweat is on to make that 1231 prospectus document look good. What's the sweat out there right now to buy these companies?
So a couple things there, Tom. And what I would say is a lot of active managers actually have had a pretty good year. A lot of the larger cap fundamentally driven funds are outperforming somewhere around 100 basis points. And much to our surprise, in the first 2 weeks of the month, they've actually improved their relative performance. And you would not expect that. Part of that is because of their underweights in the Apples and the Microsoft. And the other issue is they do have a smaller cap bias. And that's been helping them as well. So I don't think there's going to be a lot of jockeying or positioning at this point in time. I think people are pretty happy where they are, and they're going to be very interested spectators. And so this whole talk about a beta chase and people pushing their portfolios around, I don't see it just yet.
Hey, Chris, always great to catch up, sir. Thank you very much. Chris Harvey there of Wells Fargo, trying to stay out of trouble on the latest price action. Just want to bring you a correction quickly on Citigroup. The third quarter total cost of credit came in at $2.26 billion. The estimate was 3.94. I believe the original headline may have said that the third quarter total cost of credit was $838 million. That is corrected to $2.26 billion. Still below estimates, Tom, but just not by quite as much. The stock is still up in a pre-market by about 2.33% in early trading.
That was an increase of 8%, where a much larger increase was expected. So that's an important adjustment that we need to make there as well. I look at book value as well, increasing 4%, where I believe out of J.P. Morgan, I'm going to guess we got a 6% increase as well. It's amazing, John, how ratio to ratio, you just see the distinction between these two banks.
More from the big banks through the week as Q3 earnings season kicks off 3 weeks away from a general election in the United States of America. Weighing in on Washington, D.C. and beyond, Chris Kruger of Cowen Washington Research Group. Looking forward to that. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Kaylee Lines. President Trump says he feels so powerful after recovering from coronavirus, he wants to walk into a crowd and kiss everybody. The president spoke at a rally in Florida, his first stop following his return to the campaign trail. There was little social distancing at the event, although some spectators did wear masks. Supreme Court nominee Amy Coney Barrett faces questions on the second day of her Senate confirmation hearing. One of her questioners will be Democratic vice presidential candidate Kamala Harris. Yesterday's hearing wrapped up with Barrett's opening statement. She outlined her experience and spoke about the role of the judiciary. Johnson & Johnson has temporarily halted its coronavirus vaccine study. That's because a clinical trial participant experienced an unexplained illness. The illness is being evaluated. The same thing happened last month involving AstraZeneca's vaccine. That study has resumed in a number of countries, but remains halted in the U.S. In China, another sign of recovery in global trade and in domestic demand. Exports rose for the fourth month in a row, while imports also increased. That left a trade surplus of $37 billion for September. Still, the resurgence of the virus in Europe poses a threat to China's recovery. So do tensions with the U.S. And a warning from the International Energy Agency. It says the oil market will suffer a long-lasting blow from the coronavirus. The IEA predicts demand will take years to recover, and it will peak at a lower level. In a report out today, the agency says oil consumption will fall 8% this year before returning to pre-pandemic levels in 2023. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
There's nothing unconstitutional about this process. This is a vacancy that's occurred through a tragic loss of a great woman, and we're going to fill that vacancy with another great woman. The bottom line here is that the Senate is doing its duty constitutionally.
Senate Judiciary Chairman Lindsey Graham there. That's where the focus is in the Senate right now in the United States, filling the vacancy on the Supreme Court. From New York and London this morning, good morning to all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your price action looks like this Tuesday morning, 1 hour, 12 minutes away from the opening bell. Your outperformance, very, very clear. It's in big tech, up by 0.9% on the NASDAQ 100. The S&P slightly negative. If you're looking at the bank earnings, Citi out 18 minutes ago, another upside surprise. That stock up by 2.16% in early trading. JP Morgan doing better than expected as well earlier this morning. The provision build smaller than expected. We'll talk about that through the day right here on Bloomberg, on TV and on radio. In foreign exchange, euro dollar 117.90. It's a weaker euro in the mix. And in the bond market, treasury yields coming down 2 basis points to 0.755%. One for the diary, 12 minutes away, Tom, from the CPI report here in America.
No, I'm glad you bring that up, John, because frankly, that's awful important here for the dynamic of the country, looking for an 800,000 plus statistic there, which is still not acceptable. The president, he tweeted this morning, and this coming off, of course, his events of yesterday and events planned for day as well. And among them is something we have hardly touched on in this political season. You need someone expert in policy to do that. Christopher Kruger is with Cowen and their Washington research group. It's real simple. Republicans will be providing far better health care than the Democrats at a far lower cost, and will always protect people with pre-existing conditions, many exclamation points. Chris Kruger, you guys have been doing this for years. Is there a Republican plan as an alternative to the Affordable Care Act that touches upon this third rail pre-existing conditions?
No. This reminds us a little bit of the midterms in the weeks before. President Trump was talking about a new tax cut that never materialized. When you think about Obamacare, the Affordable Care Act, I think what you'll see a lot with the Supreme Court hearings beginning today at 9 a.m., the first time Judge Amy Coney Barrett will face questions. The week after the election, November 10th, is the court case on the Affordable Care Act, whether or not it's constitutional, with 23 million folks listening in who could lose their coverage in the spring. Health care is obviously top of mind, both in those hearings and on the ballot November 3rd.
Chris, how is this playing out on the campaign trail and in the polling that you've seen?
Well, I think what Democrats would tell you is that they would love to be talking about health care going into November 3rd. Generally speaking, Democrats poll better on health care. When you look at the historic wins in the midterms, Republicans losing 41 seats in the House, that was largely on the arguments that Republicans were trying to repeal and replace. And so, Republicans don't love talking about this. I think they would much rather make the closing argument a choice election between Trump and Joe Biden. But the president seems insistent on making this both about health care and a referendum on Trump.
So John will mention polling, and one Tom Keene will say, I don't buy it, any of it. I think it's all not accurate based on what we saw in 2016. What's your interpretation of where the polls are right now?
Well, I mean, the Affordable Care Act polls much better than Obamacare, even though they're the exact same thing.
Chris, I mean generally, just generally for the overall election.
Well, look, I think polling has gotten better than 2016. We've had numerous elections in this country since 2016. Just look at the president's schedule, where he is spending his time, arguably the most important commodity in the elections is where the candidates spend their time. And President Trump is going to be in Georgia later this week. He's going to be in Iowa later this week. Joe Biden is going to be in Ohio. These are not states where, 6 months ago, I think would have been, anyone would have thought that that is where both Biden and Trump would be spending their time, which would suggest that the Trump campaign is in real trouble.
Chris, I'm fascinated by what the Biden response to this is. He doesn't want to be a policy wonk right now, does he?
Look, I think, I think Biden believes that every day that this election is a referendum on Donald Trump, that's a good day for Joe Biden. We're 3 weeks to November 3rd. Although, the election isn't going to end on November 3rd, we're probably going to have one, if not two, runoffs in the state of Georgia for the Senate on January 5th. So there's still a long time to go. But all but 5 states are already in some form of voting. Over 10 million ballots have already been cast. So, we'll see how this unfolds, whether or not we even have another debate. But right now, the trajectory is looking pretty good for Vice President Biden, and Trump's tweets don't seem to be helping.
Chris, one thing we heard from the Republican campaign repeatedly is that these polls don't capture how much registration we've seen in the last couple of weeks, last few months or year for the Republican Party. Chris, what's in that argument that you're hearing from the Republican campaign at the moment?
What you hear a lot is that, Republicans tend to vote they vote the day of the elections. And what you've seen already with a number of the ballot requests on both absentee and mail-in, overwhelmingly indexing for Democrats. What you hear more and more from Republican strategists, though, is a real fear that if there are COVID spikes in the swing states up to and around November 3rd, that could decrease same-day voting. And you see the president now traveling every day, going to those swing states, holding in-person rallies where social distancing not being practiced the way I think the CDC would prefer it to be. A real fear that if you have COVID spikes on November 3rd, that's going to be a problem for Republicans because a lot of the Democratic vote is already going to be locked in.
Chris, great to catch up. Chris Kruger there of Cowen Washington Research Group. Appreciate your time, sir. The president on the campaign trail, heading to Pennsylvania a little bit later, I understand, then on to Iowa, then on to North Carolina, Tom. The battlegrounds very much front and center in the final 3 weeks of this election campaign.
Kevin Cirilli really emphasizing North Carolina. I'll be honest, John, I've got to read up on it. It's been off my radar, all these different states and the ebb and the flow of it. Certainly over the weekend, Pennsylvania was considered key. Certainly Florida behind Texas, California, New York with a large electoral vote. But North Carolina, John, I got to get up to speed on, and I hear it's really tight.
The Senate race very tight. I love what Lisa just did a little bit earlier. Just the description of this program. John says a number. Tom says I don't buy it. On repeat for the next 3 weeks, live on Bloomberg TV and radio. It was an accurate summary, Lisa.
Thanks,
very
I
accurate
try.
Indeed. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance. CPI in America, just around the corner.
कोरोना फैला हुआ है चारों तरफ। इस कोरोना के दौर के अंदर ये प्रदूषण हमारे लिए जानलेवा हो सकता है। एंटी स्मॉग गन्स काफ़ी बड़े स्तर के ऊपर जगह जगह लगाई जा रही है ताकि इसको रोका जा सके, और भी बहुत सारे कदम उठाए जा रहे हैं एंटी डस्ट कैंपेन के तहत।
Time will never come back. That was indeed a heaven view. There was less pollution. But now festive season is coming closer day by day. And again there will be same pollution, same problem.
जब कोरोना नहीं था मैं तब भी मास्क यूज करती थी, आज भी यूज कर रही हूँ, तो मेरे लिए तो कोई भी चेंजेस नहीं हुए वहाँ।
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
From London and New York, for our audience worldwide, good morning to you all, live on Bloomberg TV and radio. This is Bloomberg Surveillance, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Price action shaping up as follows. In the equity market, we look a little something like this. Equity futures down 0.2% on the S&P. The outperformance clear for all to see. It comes from big tech. A couple of things we need to do right now, one of which is get you the CPI figure and then go through some of the headlines, the projections coming from the IMF. Let's start with the CPI figure. CPI month-on-month coming in at 0.2%, in line with also 0.2% in line. The year-on-year figure, 1.4, bang in line with the estimate, just as is the core number, CPI ex food and energy year-on-year. For September, 1.7%, bang in line with the previous read and bang in line with the median estimate as well. That's the inflation number. Let me just get to the IMF projections for you. 2020 world GDP shrinking 4.4% versus 5.2 estimate that they had back in June. A rare upgrade to the projection, Tom, but still nasty. A contraction for global GDP of 4.4 relative to the estimate back in June of 5.2.
John, I don't know what you see in London with the Bloomberg headlines just rolling out, but the European statistics say all about the disinflationary tendencies and what we've heard from Christine Lagarde in the last number of days. Let me read this in its entirety, John. IMF sees Eurozone GDP drop of 8.3% this year and a gain of only 5.2% in 2021. That's too much math for me early in the morning, John, but that's a stunning statement.
The positive side of things is the shallower recession that they not just see for the global economy, but also for the US, a shallower recession in 2020. But they complement this, Tom, with a slower outlook for growth in 2021. So two stories here: shallower recession in 2020, slower growth through next year into 2021.
We have the correct guest, folks, to address this, and it affects all of our lives on Bloomberg Radio and Bloomberg Television. There's no question about that. Catherine Mann is one of our leading international economists, with her academics in America, with her work at OECD, and then now Citigroup Global Chief Economist. We're thrilled that she could join us. And Catherine, I want to go to you're so good, Catherine. You've got like 4 sidecar industries, and one of them is a deep understanding of how China fits into all this. Can China be our international GDP salvation? Can they be the one that props us up and redirects us to growth in 2022?
Well, there's always a question about who's going to be the global locomotive. And it always used to be the case that the United States was the global locomotive. That was the one who was importing and supporting the growth in other economies around the world. Well, even though the China statistics are the most robust of the economies that we have as well in our projections, they're exporting their way to growth. So they're not the global locomotive at this point. They are taking advantage of the recovery that is very sluggish in the global economy. When we look at their statistics, they did just come out with some new statistics today. The U.S. is the one that's the global locomotive for China.
Yeah.
The U.S. China exports to the U.S. are very strong. Their exports to Europe and Japan have not recovered nearly as much.
Dr. Mann, Navarro and Trumpian economics here would be it's a zero-sum game. So if China rebounds, we lose, et cetera, et cetera. Do you have any optimism into next year, into a pandemic recovery, that we can see a true additive demand away from the zero-sum myth?
Well, it is a zero-sum myth. There is, but the challenge is that domestic demand in economies, which of course has been so hard hit by COVID, until that is resolved, you will not have additive demand coming from the trade channel. So, we really need to get our consumers back on track. Very serious problem with business investment, continuing to be very, very weak this year and into next year. So, we have to get those 2 elements back on track, and then trade will follow.
John, I really want to stop the show here and say on radio and TV, John, this is incredibly important, how a lot of the thinking guests that we have push against this zero-sum concept, including Prime Minister Johnson, and we're going out to where we get additive again. It's out there somewhere, John.
The nature of the positive spillover from China's recovery, Catherine, can you walk us through how that's changed now relative to coming out of the last crisis?
Very good question, because it was the case, not only the last crisis, the global financial crisis, where China really implemented quite a bit of fiscal policy and monetary policy to bolster commodity demand as well as other demand throughout the global economy. They did it again in 2015-16. Of course, they were part of the slowdown then, and then they ramped up and were part of the global recovery. This time around, the export channel is an important channel for them, and the question mark is to what extent their choice of fiscal policy instruments and monetary policy instruments are designed to focus on internal demand versus getting exports out the door and through that channel improving manufacturing. There has been a pivot. I mean, they talk about this dual circulation, meaning both the domestic economy and the external economy. So they have the language in there that suggests that they're focusing on their domestic economy, trying to bolster that growth. But right now, we've got very strong exports, and that's an important ingredient for their GDP growth.
When the IMF comes out and they bring down their expectations for growth next year, John rightly pointed out, the story is it is a shallower downturn now. It is a slower return to some sort of normalcy. What kind of unemployment rate can we expect in the new normal, given the uncertainty around fiscal support and given the lack of growth from the developing world?
So let me say first, our forecast has been continued to drift downward for global growth in 2020. We've continued to write that down. We have also written down 2021. So we've got a little bit of a different profile for our forecast than the IMF does, but I have to say that neither one of them are positive. We also ask our economists, when do you think your economy will return to the pre-COVID level of GDP? 30% of global GDP continues to move that out in terms of the calendar. And none of them have a return to a pre-COVID level of unemployment rates anytime in the near-term horizon. So the unemployment part, the bolstering of domestic demand through consumers, that's really a very weak part of this story of recovery. And it's not of recovery. It's we only get back to where we were in January. That's just getting out of the hole. That's not a recovery.
Live on Bloomberg TV and radio with Catherine Mann of Citigroup on Bloomberg Surveillance. Catherine, I just want to tease out some of your most recent research on inflation. CPI in America out 7-8 minutes ago, bang in line.
Yeah.
You raise a really, really interesting and important topic. The gap between consumers' perception of inflation, statistical measures of inflation, and financial market pricing of inflation, and where it leaves central banks. Catherine, just build on it for us.
Right. So, even if we look at the data for consumers, what do they look at? They look at they look at food prices. They look at energy prices. Maybe at this point they're looking at auto prices. And so their perceptions of inflation are actually well above 2%. Financial markets, up until the change in the monetary policy framework by the Federal Reserve, the average inflation targeting, financial markets were very low in terms of their expectation for inflation. Now, it did bump up towards 2% when the new monetary framework came out. But the problem with the Federal Reserve, they also have to deal with financial market inflation. And of course, those measures of inflation, if we think about asset prices, if we included asset prices, we would have a much higher rate of inflation than we're observing for goods and services. So the challenge is to balance, financial market and asset prices with consumer prices. And right now, the two of them are pretty far.
A few years ago, Catherine Mann put out a small monograph. The first time I heard about it, when Lawrence Kudlow yelled at me, "Shut up and read this monograph." And I did, Catherine Mann. It was called "Is the Trade Deficit Sustainable?" It was a classic immediately by Dr. Mann. How about this, Catherine Mann? Is the twin deficit we have created sustainable? Nobody believes it is. Do you believe in a glide path to a regression that we're familiar with? Or are we in uncharted territory here?
Well, in terms of the fiscal deficits and the debt profiles, absolutely we're in uncharted territory. We've never had a post-World War type of territory anyway. We've never had these kinds of numbers before. We've never had these trajectories, not just for sovereigns, but also for non-financial corporates. The only ones who seem to be in control at this point are households in the United States, at least. So this is a debt trajectory that is unparalleled. And, there's only a couple ways out of this. The good way out, of course, is to have an innovation surge, have a productivity surge, a support for the capacity of the economy to repay its obligations. Same thing for companies. That's a wish. That's an aspiration at this point. We could imagine maybe something coming through with climate innovation and climate adaptation and mitigation. These are ways in which we could get a productivity surge that would be supportive of being able to repay the debt. The other way, of course, is to inflate it away. A little bit of inflation would be a good thing. The Fed has made it clear that they are willing to have inflation run above the 2% for a good period of time. And for statistics...
Catherine, I'm just trying to give you a book to write. Come on, I need you to write, is the trade deficit, is the twin deficit sustainable?
I'm going to write another one, but this one is going to be talking about both the capital account and the current account. Because the other question that people ask is, when does the capital flow into the United States, which of course is the counterpart to the current account deficit, when does that capital account surplus start to erode? And that, of course, has to do with the sustainability of the dollar as a reserve currency. Another big topic.
Catherine, great to catch up. Always tremendously smart. Catherine Mann there of Citigroup. Thank you. Tom Keene, did Larry Kudlow used to shout at you?
Kudlow and I used to go back and forth all the time. This is even pre-CNBC for Lawrence Kudlow, going back Bear Stearns days and all that. And we were both reading the same book at the same time. Catherine Mann. You had to read it at the time. I used to walk around with it just to be cool.
I'm going to be nice to Larry from now on. I love him even more now. Larry Kudlow, Shannon, Tom Keane.
Yeah.
Wonderful thing.
It's a great
thing. To see it.
Is the trade deficit
Alongside
sustainable?
Tom Keane and Lisa Bravitz, I'm Jonathan Ferro. Equity futures down 6, NASDAQ futures flying, bank earnings in focus.
Entry point, I'm looking, Lisa, come on.
Yeah, I don't know.
This is Bloomberg, here all week, Monday to Friday.
With the First Word News, I'm Kaylee Lyons. President Trump is diving right back into campaigning. He told an audience in Florida he felt so powerful after recovering from the coronavirus, he wanted to kiss everybody. There was little social distancing at the rally at Orlando Sanford International Airport. Some spectators did wear masks. Joe Biden says he's not a fan of expanding the Supreme Court. It's his clearest answer on the issue yet after weeks of dodging the question. Biden was speaking in an interview in Cincinnati. The idea of adding seats to the Supreme Court has gained traction among Democrats. Many are angry that Republicans are rushing through the confirmation of Amy Coney Barrett. Coronavirus infections are soaring in several Republican strongholds and in the key swing state of Wisconsin. 3 weeks before the election, the hardest hit states are now North Dakota, South Dakota, Montana, Wisconsin, and Utah. Hospitalizations are also on the rise in all 5 states. BlackRock's assets under management rose to a record $7.8 trillion in the third quarter. The rising stock market was one reason, plus there were inflows to all of BlackRock's product lines. That includes everything from ETFs to alternative investments. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's already gotten bad. That's showing up in the numbers and likely to get worse as we go into 2021. And one notable part of this global recession is the inequality.
A sobering conversation with David Malpass there, the World Bank president, just ahead of the IMF World Bank meetings from London and New York this morning. Good morning. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Counting you down to the opening bell with bank earnings in focus. Looking forward to catching up with Gerard Cassidy, RBC Capital Markets Equity Research Director. We'll do that on Bloomberg TV in about 15 minutes, Tom.
John, a conversation made more interesting here with the differences, the distinctions between J.P. Morgan and Citigroup. Always good to catch up with Mr. Cassidy of Maine. Right now we diverge to Kentucky. Tim Adams is with the Institute of International Finance, their president and chief executive officer. I will not mince words. He has reinvigorated the Institute. It was 400 guys standing around in suits and ties, and he put a spirit into it last year of a debate on our economics and the financial system around it. We're thrilled he could join us today. Tim, what is it like to pull off a virtual conference after the excellence I personally observed last year? How do you do virtual?
Yeah, Tom, well, thanks for having me this morning. I got up early this morning, really looking forward to being here with you today. We've got 70 different sessions over 5 days, 60 hours of programming. It's almost our own little network. So we're learning by doing. We got great speakers, Jamie Dimon, Larry Fink toward the end of the week. So it's all about content, just like you, Tom. It's all about content.
I look at your resume out of Kentucky, your work with Secretary Snow, Secretary O'Neill, et cetera, and you've got the process and the machinery of fiscal stimulus in you. You've executed that before. Do you have an optimism that if or when we get fiscal stimulus, we can execute it better this time?
I certainly hope so. Look, this town, when it wants to, can execute well, but it requires leadership at the top, where the message is we want to have flawless professional execution. This town attracts a lot of really smart, interesting people, and it populates with great people. We just need to be given the task to do it and do it well.
Right now, the IMF is holding their meetings in addition to everything else going on. Does the developed world care enough about the carnage going on in much of the emerging markets right now?
Oh, absolutely. I've spent the last 8 weeks on the phone with finance managers, central bankers from emerging markets, a lot of developing countries, especially sub-Saharan Africa. We are incredibly engaged with those countries. We're listening to them, and we want to help them.
All right, so we've heard about debt relief. Are we going to be hearing more and more about debt forgiveness on a magnitude never before seen?
I don't know about magnitude never before seen, but certainly countries have an opportunity and option to reach out to their creditors, official, bilateral, and private, to find a way forward. Currently, it's a liquidity crisis. It's not yet a solvency crisis, but we're working toward what a solvency adjustment may mean over the next couple of years. Absolutely.
Tim Adams, one of the themes we're seeing as we dive into big bank earnings season, and of course the Institute of International Finance folks, is about the representation and the voice of our larger financial institutions globally. Tim Adams is the export of our banking skills, and that the major banks in America can go over to Europe and can compete. They can go over to Asia and compete. Is our government holding them back, or can they constructively compete?
Well, to your point, Tom, we had great news out of J.P. Morgan, Citi, and BlackRock today. World-class institutions. They can compete. They are competing. They are getting access to markets around the world, including China, which is a huge opportunity for U.S. institutions. Look, we need to see more consolidation in the U.S. We'll see more consolidation across Europe. Scale is your friend, and namely just because the technology spend. But U.S. and European institutions are world-class. They can compete anywhere.
Tim, but this is important. We have liberties restricted in Hong Kong. What is the IIF approach to allowing Western capitalism to work in China if China restricts those opportunities specifically in Hong Kong?
Tom, the Chinese government, we have 35 Chinese institutions. I have an office in Beijing, have been very forthcoming in attracting non-Chinese financial institutions. They want the technical expertise. They want the foreign capital. I've been going to China for close to 30 years. There really is an open door for U.S. financial institutions. I think there's a very good relationship there.
Okay, the relationship is there, but how do we compromise with a new tone from Beijing?
Well, it's just going to require greater diplomacy, and whoever's in the White House starting the third week of January is going to have to hit the reset button and find ways to work with President Xi Jinping and look for ways where we do have a common theme, and that is climate change. It's about pandemics. It's about financial. It's about energy. There are a whole host of issues where we need to work together for a common collective outcome.
Tim, I've got to ask, we're in the heat of the election season, 21 days to the election. I believe the senator from Kentucky has a win in hand. I think that's what the polling out of Louisville tells me. Give us an update on Kentucky politics.
Yeah, don't ever vote against or bet against Mitch McConnell. He's an incredibly great politician. He's been doing this a long time. He's also a good majority leader in the Senate. And maybe he'll continue being a majority leader. We'll see. But never bet against Mitch McConnell. He'll win this race handedly.
Tim, if we do get this is an if we do get a President Biden, you are associated with a Republican Party removed from President Trump. Does the Republican Party shift back to the decades of work you represented, or is it Trumpism forever?
Oh, that's a great question, Tom. I hope that we return to a vision that I certainly worked for Ronald Reagan and George Bush and others, really about building strong institutions, about rule of law, about engagement globally to solve common collective problems. I hope that's the case. If not, I'm willing to work with the Biden administration on a whole range of issues, including sustainable finance.
Very good. Tim Adams, thank you so much. Congratulations to the Institute of International Finance. This year, virtual within those Washington meetings, is we have virtual World Bank, IMF, and Milken Institute. It is that season of October. On the IMF, I need to remind you of Francine Lacroix's important panel today at the International Monetary Fund, including Lawrence Fink of BlackRock coming off those good earnings, and of course, an important interview of Francine's with the managing director of the IMF tomorrow. Let me give you a data check right now. We look at markets that have ebbed away from the NASDAQ enthusiasm seen 2 hours ago, still up 0.5% on the NASDAQ as it exploded yesterday. Of course, that Apple meeting at 1 p.m. Eastern time, as I've said before, just my considered amateur opinion, it's different this time around. This is a meeting that will really have to live up to the huge expectations of the technology crew and the fanboys. Yields come in, no question about that. The 10-year yield in 3 basis points, 0.74, and a 30-year bond, 1.53 as well. The International Monetary Fund about an hour ago out with their report, and it's real simple. The 2020 call is maybe a little less grim than what we saw in April, but I'll tell you, the 2021 view is cautious, and that means it will always be a good time to speak with Gita Gopinath of IMF chief economist. Gita Gopinath here goes beneath those headlines that we saw in the acclaimed Blue Book of the IMF. So you can look for that as well in our 10 o'clock hour. Please stay with us on Bloomberg Radio and on Bloomberg Television. Good morning.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London for our audience worldwide, good morning, good morning. The countdown to the open starts right now, 30 minutes away from the opening bell with equity futures slightly negative on the S&P. We're flying on the NASDAQ and we begin with the big issue. Earnings season begins.
The setup in the earnings season is great.
We are very close to against near record highs.
Investors have sort of been held back by just this very boring debate on fiscal stimulus.
Overall, I think the investors are largely looking past this earnings season.
Driving markets going forward will be optimism about earnings.
We could see positive earnings year over year for tech and definitely healthcare.
The expectations are so low right now.
The big wild card here is going to be consumer.
Corporate earnings have hit the bottom.
The low point for bank earnings was likely the second quarter of this year.
We're going to be stunned by the degree of earnings upgrades that we see.
It only gets better from that admittedly very low point.
Earnings season is going to be great.
The big banks kicking off earnings season on a high note. Citigroup posting its biggest quarterly profit of the pandemic as JP Morgan reports a surprise increase in earnings. For more, let's bring in Bloomberg's Shonali Basak, shall we? Good morning to you, Shonali. Your early take, please.
Good morning, John. And you're seeing investors react to the bright side of these earnings with both stocks up in the pre-market. Citigroup and JP Morgan up almost the same amount, but remember, Citigroup sold off more than 42% on the year compared with 26% at JP Morgan. The loan losses did come in a lot less than expected, but if you take a look at both of these banks, you're seeing a different story in terms of how well JP Morgan is performing on the investment bank. Much bigger jump in increase there than you've seen at Citigroup. Citigroup is starting its call with the media as we speak, and they will have to answer the questions as to whether they're losing or gaining share in some of those businesses. You also see a much bigger divergence in the consumer businesses here, a much bigger drop at Citigroup's business. But I do want to point us back to the bright side here because analysts and Wall Street are looking at the fact that perhaps the economy is not doing as bad as they initially expected. We're seeing Michael Corbat saying that the credit losses are stabilizing, and we're seeing Jamie Dimon saying that the provisions are better. Their expectations for unemployment and GDP have gotten a little bit better on the margin. But again, Jamie Dimon this morning on the call with media sounding the alarm for a greater stimulus package needed. Otherwise, we may see a lot more pain ahead.
It seems, though, at the moment, Shanali, the good news is that the major provision build is behind us. And naturally, whenever we get through the first couple of names, we start thinking about the read across to the other big banks. What's the read across at the moment for you, Shanali?
Right now, the consumer businesses are doing a little bit better, except remember, loans are down, net interest income is down, so there's still sore spots. And even as deposits rise, deposit margins have been decreasing as well. So I wouldn't get too excited because analysts are already asking about what's the future outlook for these businesses in a pretty bleak environment for growth. So, John, still a lot of pain ahead, but as Mike Mayo had told you, perhaps the worst is over.
Shanali, great work, as always. Shanali's week starting big time this morning with bank earnings rolling in. We'll catch up with Shanali in about 30 minutes' time, breaking down the numbers at the opening bell and getting you some insight into some of those calls. The price action shaping up as follows. 27 minutes out from that open, equity futures down 0.4 on the S&P 500. NASDAQ 100 futures were up big a couple of hours ago. We fade that. We're still positive by about 41 points on the NASDAQ. We advance about 1/3 there. So that's the price action in the equity market. Here's a take from RBC's Gerard Cassidy, expecting the pandemic's containment policies to impact bank earnings this quarter and writing the following. The upcoming results will be confusing, sloppy and surprising for some banks, but our outlook is cautiously optimistic as we expect the economy to continue to gain momentum into the end of the year. I'm pleased to say that Gerard joins us now for more. Gerard, let's start with your words. Confusing, sloppy and surprising. What was confusing, sloppy and or surprising about what we've seen this morning?
John, I think what's confusing and sloppy is that nobody knows, and we're hearing this on the call with JP Morgan as we speak, nobody knows how impactful the stimulus plan has been to these very strong credit numbers we're seeing. We know that the economy is recovering, and we're not certain just yet whether the economy can stand on its own 2 feet and continue to deliver these strong credit numbers. So that's the real confusion here. And I think, granted, these are good numbers. The credit numbers are very strong, but there is a little bit of confusion on a go-forward basis on how important the second stimulus will be to the economy.
So, Gerard, are we sitting here and saying, even for the banks, their outlook right now is just dependent on whatever happens next in Washington, D.C.?
It is partly dependent upon that. Absolutely, John. I think what we have to look at is we've always pointed out that banks are products of their economy. So if the U.S. economy, as you know, is going to have some incredible growth in the third quarter, but that's more of a mathematical exercise to the second quarter. But if we start to see 2 to 4% real GDP growth in the fourth quarter and first quarter of next year, then we're going to start to see the all clear signal for the banks to be able to grow. And that is going to be the challenge for 21, is growing those top line revenues.
We heard from the IMF around about 35 minutes ago, for whatever their projections are worth, a shallower recession, but a shallower recovery through 21. I want to read you the words of Jamie Dimon 3 months ago today. Basically 3 months ago precisely, last quarter, Gerard, when he said this is not a normal recession, the recessionary part of this you're going to see down the road. You will see the effect of this recession. You're just not going to see it right away because of all the stimulus. Gerard, have we seen any of it yet?
That's John. In bank earnings, we have, because the provision for loan losses has been so elevated due to the new accounting procedures that the banks use. And so I think peak provisions are behind us. So the earnings have been definitely impacted by this recession because of the higher provisions. But the credit losses, we have not seen a material pickup as we normally would have seen if it wasn't for these stimulus programs.
So you and I would often have a conversation about loan growth, where we are sequentially, quarter on quarter, year on year. Let's talk about that, Gerard, and let's also talk about how profitable those loans are going to be. Gerard, walk me through it at the moment.
What we're going to see, John, is that the organic loan growth has been actually flat to down, and that's to be expected in a recession. What you saw in the earlier part of the year from loan growth were the government PPP loans, the Paycheck Protection Program loans, and as well as the corporate lines of credit being drawn down. The lines of credit are now being repaid. The PPP loans are being used. So the actual organic growth is going to be flattened down through the end of the year, in our view, which is very normal during a recessionary period. As the economy grows, we expect to see loan growth start to pick up. And historically, John, loan growth tends to track the nominal GDP growth numbers. So if we get nominal GDP growth of 4 to 5%, seeing 2 to 3% loan growth next year is not unreasonable.
Jared, these banks are still making money. And I think the question of this morning is, where is the money going to go if the buyback plans have been suspended? I don't think the right question is to work out what the rest of the year looks like. It's to work out what 2021 looks like, Gerard, for the capital return programs of these huge names. Have you got any projections right now?
Yes, we do. As you know, John, and you pointed it out, the Fed has put in the temporary suspension of buybacks similar to what they did in the third quarter, and they've limited the dividend payments as well to the average of the prior 4-quarter earnings, which is not going to be a problem for most of the banks. But we do expect the Fed to lift that temporary order. It could be lifted as soon as the first quarter if these numbers continue to improve the way you're seeing them. So I think we're and other investors are expecting the buybacks to be restarted next year. In our models, we're putting them in the second half of the year. But if the strength of the economy continues and the numbers continue to look like what we're seeing today, I think the buybacks may start in the first part of next year rather than the second half.
Do you expect to see stronger, more aggressive cost cutting going along with that as well, Gerard? Because quite clearly in the last few quarters, there's been a real stigma attached to doing that. And now there's a real boldness in the C-suite that I think we can all identify, where people feel a little bit more confident about making the decision to cut. Do you see the aggressive cuts?
Yes, we do. And you put your thumb on it. We've seen this in past downturns as well. So it's taking a page out of the old playbooks. And we're already seeing some of the banks announce. Fifth Third, for example, announced a major cost-cutting program about a month ago. We expect to see more of that as the banks look to improve their profitability in a slower revenue growth environment by cutting costs. And on top of that, when you take a look at the digitalization of banking, there's no need for the number of branches that the United States banking industry has today, and you're going to see more branch closures and consolidations because customers are just not using branches as much as they did 5 years ago.
And that's certainly accelerated through this pandemic, Gerard. Just a final word from you, please, sir. JP Morgan up in a pre-market by a little more than 1%. Citi up by 0.9%, 20 minutes away from the opening bell. Later in the week, we'll hear from more names. Who have you got your eye on, Gerard, specifically in a more constructive way going into reporting season?
I think everybody should keep an eye on Bank of America. You know, they are a big consumer lender. You saw the numbers today. They're very similar to a JP Morgan. And then on top of that, you need to look at Morgan Stanley. Morgan Stanley obviously is going to benefit from the strong capital markets business. So those would be two distinct names to keep an eye on. And on the regional side, we take a look at Truist. Truist is the merger between BB&T and SunTrust, and they've been putting up some good numbers, and we expect that to continue in the third quarter.
Gerard, lucky to get you on the programme today. I know you're super busy, so thank you for your time, sir. Gerard Cassidy there of RBC, 20 minutes away from the opening bell with equity futures down 0.4 on the S&P 500. Big gains on the NASDAQ fading as we move closer to the cash open. At the market desk with your movers, here's Abigail.
Well, John, we certainly had big gains yesterday for the NASDAQ 100, up 3%, outperforming its best day since the middle of April, and that had everything to do with big tech. So the strength is fading a little bit this morning, but nonetheless, we do still have some strength here. And the big winner yesterday, Apple, up more than 6%. Right now, up about 0.7% ahead of their iPhone event, that virtual event, the reveal of new iPhones. Amazon.com up about 0.5%, up 0.6% as their Prime event starts. And we have some strength of the chips today. Micron getting a boost from Deutsche Bank, raising their rating to buy on DRAM demand, expected to be strong. And Intel is up after Gartner put out a report talking about the strongest decade for PC buying in more than a decade on the trends around the pandemic. So as you point out, that tech strength is fading, but there is still some green on the screen, at least right now, John.
Abigail, thank you. Coming up on the programme, the election and its impact on markets. That conversation coming up with CEO Chris Mayer of Ocean First, the president returning to the campaign trail.
Now they say I'm immune. I feel so powerful. I'll walk into that audience. I'll I'll walk in there, I'll kiss everyone in that audience. I'll kiss the guys and the beautiful women and everybody. I'll just give you a big fat kiss.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We are doing better by far than we ever did in 2016. We're going to have, if it's possible, an even greater and more important victory than we had just 4 years ago. We are more successful now than we've ever been before. Take a look at what's going on with our economy. We're about to hit another stock market record, 401ks.
President Trump firing up the base during a rally in Florida as Vice President Biden delivers a much different message in Detroit.
Unemployment is way up due to the pandemic and the terrible way in which it's been handled. Folks are worried about making the next mortgage payment or the rent payment. They see the people at the very top doing better than they ever have, while they're left to wonder, who's looking out for me? That's Donald Trump's presidency.
21 days remaining until the election, 3 weeks away. The president touring key swing states where recent polling shows him trailing in Michigan, Wisconsin, Florida, and Pennsylvania. Bloomberg Chief Washington correspondent Kevin Cerruti joins us now from Capitol Hill. Good morning to you, Kevin.
Good morning, Jonathan. Here on Capitol Hill, all eyes on Judge Amy Coney Barrett. But for the Republicans on the Senate Judiciary Committee, they're playing, well, both teams here in trying to confirm Judge Amy Coney Barrett, but also trying to navigate some treacherous political waters that show President Trump with a significant trailage in the polls behind Vice President Joe Biden. So the tension really palpable here in the halls of Congress, Jonathan.
Kevin, for individuals that don't watch the show just before this, with myself, Tom Keene, and Lisa Abramowitz, this is what it sounds like most days. I go through the polls, and then Tom pushes back aggressively against them. I did this earlier. Lisa laughed, as she traditionally does on that program. I'll do it again with you. The Siena College New York Times polls, 8-point lead in Michigan for the former Vice President Joe Biden. Wisconsin, 10-point lead. These were the swing states, the battlegrounds for President Trump that he won by really narrow margins back in 2016. When you put these numbers to the Republican campaign, what comes back at you, Kevin?
They want to have a hot red turnout on Election Day. And in fact, I think that's why you're seeing President Trump barnstorming across several states, whether it's in Florida, Iowa, Pennsylvania, North Carolina. He feels that if he shows up, that he can get all the local media coverage and that he can really drown the conversation out and really force many Republicans who were disenfranchised with the Republican establishment party of yesteryear, that he can mobilize that and have them show up to the polls. In contrast, the Biden campaign is banking that they are going to be able to get and pull away some of those old establishment type Republicans who are a bit skeptical of the way the president has communicated his message. It's really why Biden came out yesterday and said that he was not in favor of packing the Supreme Court with additional judges. That was a clear calculation, I'm told, on behalf of the Biden campaign to try to win over suburbanites and really a show of confidence that they feel they have the base of their party firmed up and that they'll turn out for them on November 3rd and in the mail-in ballots.
And put to bed a perceived area of weakness as well. Kevin, great to catch up, sir. Looking sharp. Kevin Cerulli there from Capitol Hill. Thank you, sir. Ocean First CEO Chris Mayer recommending investors pay close attention to the congressional races and not just the presidential election, writing the following. While a lot of the discussion and focus is on the White House, the Senate may be equally important to markets as it will determine the degree of policy room for whomever wins the White House. Joining us now, I'm pleased to say, is Chris. Chris, you've gone through three phases here: pre-election, post-election, post-pandemic. Let's just deal with pre-election, post-election at the moment. Your thoughts on how to navigate this at the moment?
Sure. I think we can expect, and good morning, John. Great to be with you. I think we can expect between now and the election a lot of that speculative movement based on the news cycle, where whether it's a poll or an issue that comes up where you see a swing back and forth and people handicapping who may win on one side or the other. And that repositioning is just going to be a trading opportunity. It's not really a long-term investing opportunity. And that'll distinguish itself from, I think, once we know the outcome of the election. And, you know, be careful. This Bush versus Gore, it took 35 days for us to understand the outcome for the election, and we may have a similar time period here. Again, that would be marked by speculation.
Chris, it's amazing how the speculation has swirled on Wall Street, beyond Wall Street, given there's hardly anyone there at the moment, but you know where I'm going. Over the last couple of weeks, the narrative flip has just been incredible. The focus was exactly what you described. Then in the last couple of weeks, it's shifted to a blue wave and all the good stuff that could possibly mean for markets without thinking about the potential tax hikes. Chris, that's the market conversation. You've got real corporate clients. Can you walk me through what those conversations sound like right now?
Sure. I think everyone's looking for a reason to be optimistic, and our clients are the same way. I think the difference is that while if you look at the markets in Wall Street, they can find an argument on either side. Our clients, commercial entities, are looking for a way to make decisions in the short term. And if you don't know where tax policy is going, if you don't know which sectors may be favored by a new administration, that can become an issue. And that was my point about the Senate. We need to see exactly how much change we may be through. Is this going to be, working around the edges of our policies economically, or extremely strong fundamental change? And that's going to change the way our clients make investments and put capital to work.
Across the various sectors that you cover in that client base, Chris, where are the worries more pronounced about unwinding the Trump tax cuts?
Yeah, so I think that if you look at the tax-advantaged industries, so there could be, for example, energy has a lot of tax advantages. That's where you're going to start to see maybe some speculation around long-term earnings. I think on the other side, look, financial sector, I run a bank. Our industry typically has very few tax advantages, so we pay very close to the statutory rate. So if the statutory rate goes up, most banks are going to pay higher taxes. And I think that's been one of the headwinds in the bank investing market this year.
Chris, let's finish on the banks. The story of this morning is about loan loss provisions, particularly JP Morgan being much smaller than anticipated. The truth is, as Gerard Cassidy of RBC pointed out, they are the provisions, maybe the big builders behind us, but the losses are ahead of us. Chris, from what you see at the moment, who isn't getting paid, and when are we going to start to see those losses?
Yeah, so the first thing, let me say about the losses. In any recession, you see the actual credit charge-offs being pretty far removed from the recession itself. So if you go back to 2008, you saw peak charge-offs in 2010. So it takes a little while to work things through, especially in many states. There are restrictions on foreclosures, understandably so, or even evictions in commercial buildings. So it takes a little while for the losses to show up, but especially as your former guest noted under CECL, we're required to take those provisions as soon as we can estimate them. And I think for most banks, you're going to see either the second or the third quarter was probably peak provisions. And it depends a little bit on whether you had a consumer portfolio or a commercial portfolio, because the consumer portfolios are a little bit easier to handicap in the short term, where in the commercial side, you really need to get through individual borrowers and understand how their business is going to react. So, but I think whether it's second quarter, third quarter, it certainly looks that by the end of the year, credit will be kind of in the rearview mirror, and we'll be looking forward to margins and growth and the issues for next year.
Chris, just a final question from me on the loan loss provisions. Quite clearly, the South Side has had difficulty estimating those provisions, looking at where they were relative to the actual number that came out from JP Morgan. How difficult is it for you guys to actually estimate how much you need to put to one side?
It's incredibly difficult, especially in this market where we've all given a certain amount of forbearance to our customers. That's kind of like an anesthesia for the patient. You can't tell how good the patient's doing. So you have to work through that, and the forbearances kind of roll off, and most of them in October for many banks. And that's where you're seeing the true performance of the portfolio. So it may take a little while more. It may be a third quarter peak in provisions for some banks. But I think it does get, we figure out exactly where things are by year end in almost all institutions.
Chris, don't be a stranger. Got to catch up around the election result. Chris Mayer, whatever that might be, of course. Promotion first. Thank you, sir. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, we're previewing Apple's highly anticipated iPhone 12 release with the wonderful Evercore's Amit Daryanani. Looking forward to that chat. Coming up right here on Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Five minutes away from the opening bell, equity futures slightly negative, down 12 on the S&P, off by a third of 1%. The rally in NASDAQ futures this morning fading a little bit as well. That's the price action. Here are the morning calls. A look at some of the analyst recommendations on Wall Street this morning. Susquehanna downgrading American Airlines to negative, $8 price target. The analysts seeing uncertainty surrounding the recovery, with risks increasingly skewed to the downside. Goldman upgrading Exxon to neutral, $36 price target. The analysts saying that investor concerns are justified, but those risks are now priced into shares following some big underperformance. And your third and final call from Deutsche Bank, upgrading Micron to a buy, $60 price target. The analyst expressing a more positive view towards memory chips, with industry checks suggesting a pickup in demand. Micron stock up by 2.3% going into the open. Up next, Apple, the biggest product launch of the year. And we do that with Evercore's Amit Daryanani.
The Census Bureau has asked Congress for a 120 extension. I don't know that you even have to ask, and I think 120 days isn't nearly enough.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Show me an index in the green, and I'll find you an equity bull to tell you a nice story about why we're there. I've got no idea what the Nasdaq was doing in the last 24 hours. We had a little bit of weight to it going into the cash open, up 53 on Nasdaq futures. We advanced 0.4% on the S&P. Slightly negative, down 9 off by a quarter, 5 seconds away from your opening bell, which you hear already. Switch up the board in the bond market. CPI behind us, PPI ahead of us. That's tomorrow morning. Claims on Thursday, retail sales on Friday. Bid into the bond market, treasury market, reopen. We get back to work. We're down 3 basis points on a 10-year to 0.74%. Dollar strength against the euro, weaker euro, 117.67, down 0.4%. And crude, a 40 handle again, up by almost 2 percentage points on the session. That's the cross-asset price action this Tuesday at the market desk with your movers. Back with us, here's Abigail.
John, it's very interesting that divergence that you were noting between the Dow and the S&P 500 being lower, the Nasdaq higher. So we have a few leaders and many laggards to take a look at as well. So starting out with the leaders, Disney is popping higher. This, of course, on yesterday's announcement to reorganize their structure and put more focus on streaming. Their film and TV studios will take over Disney Plus, and movies will be released released through Disney Plus going forward until there's more normal movie theater action. BlackRock, the asset manager, put up a very strong third quarter, double-digit beat on both the top and bottom line. They also have now record assets under management of $7.81 billion. That stock into today, up more than 20%, in contrast to the money center banks all down, perhaps helping to explain why Morgan Stanley's James Gorman recently did acquire Eaton Vance, or made that move. Johnson & Johnson down. They put up a good quarter, but they have halted their COVID-19 vaccine trials as one patient has unexpectedly gotten sick. And then finally, Royal Caribbean plunging down 8.2%. They are raising another $1 billion, John, to help them survive during this time period where boats aren't in the water for the most part.
Abigail, thank you. Thank you very much. 1 minute, 40 seconds into the session. Equities down on the S&P by 0.1%. On the Nasdaq, we advance 1/3 of 1%. Big tech looking to extend its rally to a fifth session after recording its best day of gains since April, keeping the rotation into value on hold for just a little bit longer. Chris Harvey of Wells Fargo weighing in.
You've seen some of the Uber caps really underperform month to date. You have some really positive news, or potentially positive news, coming out of some of your Uber caps, whether it's Apple or Amazon, and so they're beginning to bounce. The other thing is you still have a fair amount of retail money in the marketplace, and those are names that are fairly well known and well loved by the retail names.
Bloomberg's Sarah Ponzek joins us now for more. Sarah, it just felt like August light, didn't it? That's what yesterday felt like. What was it?
Right, it did feel a bit August light, and some investors were pointing out the fact that it was almost deja vu once again. I mean, the persistence of these NASDAQ gains continue to be amazing to watch. Since September 23rd, the NASDAQ is now up about 12%. There you can see up about 8%, I guess, for now. At the same time, consider the fact that ever since that antitrust report was released last week, the NASDAQ has gained every single day and added about $1 trillion in market cap. So why the optimism? Now, there's a couple theories out there. One, you look at product events. You have Amazon Prime Day today, also an Apple product launch. Some also say mean reversion. Think about the beginning of the month. The NASDAQ actually underperformed the Russell 2000 by 6 percentage points. Usually gaps of that level have really seen reversals then follow. Some point to politics, fiscal stimulus, but of course there's also the options market, and that is what is August light. So last month, SoftBank was revealed as the, quote, NASDAQ whale. However, yesterday, in an interview with Bloomberg at the Milken Institute's virtual conference, the CEO of SoftBank Investment Advisors came out and said, quote, SoftBank is not even a dolphin, let alone a whale. He also threw cold water on the idea that SoftBank has the ability to move markets, to move the NASDAQ. And that kind of jives with this idea that maybe it's not SoftBank. It's actually smaller day traders, because what they're doing is they are buying these shorter dated call options that thereby force dealers to do delta hedging, and that can then lead to an increase. So we have seen stock options volume in single stocks much higher than at the benchmark level. If you were to look at Microsoft, Apple, for example, compared to that of options volume in QQQ, that large ETF. So that is the talk on the street right now, that what we are experiencing is a gamma squeeze. However, at the same time, we do have earnings on board. That'll come up starting mid next week into the following week. We'll hear from the likes of those major mega cap tech names, ending out on October 29th with the last two. That'll be Facebook and Apple then, John.
Is the tail wagging the dog? The question we asked through much of September and out of August. Sarah, fantastic work, as always, tremendous. 5 minutes into the session, Apple down by about 1% in the early part of trading. Yesterday, up just massive, up by a little more than 6%. Unveiling its latest 5G iPhone today at its highly anticipated launch event. Wedbush analyst Dan Ives calling it the most significant product cycle since the iPhone 6. Back in 2014. The virtual event kicking off at 1 p.m. Eastern from Apple's Cupertino headquarters as the company enters its busiest sales quarter. Joining us ahead of that, good friend, our correspondent, Ed Ludlow from San Francisco. Morning, Ed. Early morning for you, sir. What are you looking out for later?
Good morning. Investor expectations are high for this generation of iPhones, John. Look, we're expecting 4 new models that sources say will include Apple's own A14 processor, much faster processing power, new squared offside rather than curved, upgraded cameras, split across 2 high-end and 2 low-end models. And it's actually going to be the broadest variety of screen sizes that Apple has ever offered on the iPhone. But the main ticket here, John, is 5G. You see the first major redesign in years, coupled with the promises of higher speeds that 5G brings. Many analysts see that spurring an upgrade cycle, right, where users of older generations of phones setting Apple up for significantly higher unit shipments in 2021. Sources have told Bloomberg that Apple has asked its suppliers to build around 80 million units to ship in 2020, a pretty bullish sign of demand that iPhone demand's holding up, right, amidst the global pandemic, amidst the recession that has caused. And we know all about Apple's broader ambitions around content and services, but at the end of the day, iPhone still generates around 50% of Apple's revenue, and that can climb to as much as 60% in the holiday quarter. With those 5G speeds, of course, Apple will be hoping to get a boost in its services sales growth. If there's one cause for concern, John, sources have told Bloomberg that in testing, Apple employees have found that this new generation of iPhones here in the US has actually not yielded that much faster connection speeds with the current 5G network. And we got a survey overnight from Piper Sandler that found only 10% of the respondents that they surveyed actually plan to buy or upgrade to a 5G phone this fall. And of course, some of them are citing budget constraints. We know from Apple's fiscal third quarter that stimulus was a big driver of demand. So that's a question going into this holiday quarter. Will the price points make this an attractive product for the US and Chinese consumers as well?
Just slow down the old ones. Not saying they do that, of course. I'm not implying that. Ed Ludlow on the West Coast. Ed, thank you, sir. Evercore's Amit Daryanani expecting Apple to continue rallying with demand for products remaining robust. Amit joins us now over the phone. Outperform rating on the stock, 135 price target. Amit, let's start with the hardware, sir. What are you looking for a little bit later today?
Yep. Good morning, guys. So, our expectation, you're going to get the 4 iPhone launch, 4 models come out today. The expectations are obviously very high for these devices, given how well the stock is done. I understand the price sensitivity everyone's going to have, but I do think eventually what's going to matter, at least on the event today, is what the price points look like, what the battery life looks like for these phones, and then eventually as these phones really come out to the market, I do think carrier promotion, carrier subsidies, and Apple's own financing and trade-ins could have a very big factor in terms of what end demand looks like over here.
Amit, my colleague Ed mentioned the upgrade cycle. You and I talk about that seemingly every time we speak. How pent up is that demand to upgrade into this one?
Yeah, so iPhone replacement, from the data we have analyzed, would suggest average consumers holding the iPhone for pretty close to 4 years at this point. PCs are held for north of 5 years as a perspective, right? So north of 4 years, it's probably the highest level we've seen in about 7-8 years for iPhones. And I would argue the one thing we've all kind of witnessed through the pandemic is we've been using these devices extensively. So 5G or no 5G, I do think more people would be inclined to upgrade their new phones to the new phones, given how heavy the utilization rates on these have been so far.
Amit, what's the Apple One bundle? What's that all about?
At the end of the day, I think a big part of Apple's narrative has been how do we monetize the iOS install base to users more extensively? And what the Apple One bundle simplicity does is gives you, things like Apple Music, iCloud, and so on, in one form, in one format, for a lower price, $19.99 is the family bundle. Essentially, the incentive would be if you're an Apple user and you use iCloud but not Apple Music, perhaps this is a way and an incentive for you to shift away from a Spotify or something else towards the Apple ecosystem.
Keeps us all in the ecosystem, and it leads us to the regulatory question, Amit. Apple really wasn't part of that conversation in a big way, and I'm speaking relatively, until recently. Is that starting to look like maybe a weakness on the horizon, Amit?
This is always a concern for Apple, but as much in the U.S. as it's in Europe and other parts of the world, I do think to the extent you have events like the Epic lawsuits happen, it does create some degree of public fear, or at least stock fear, in terms of is Apple forced to separate something around services or take a lower take rate on the App Store? So I do think it's a risk. I would argue it's perhaps somewhat more of a headline risk versus a real risk to the business. And to your point, when you look at the regulatory filings, Apple is a distant fourth out of the 4 companies that they all talk about typically.
Just a final question from me. From an analyst perspective, from a personal perspective as well for you, when you see a stock move like yesterday and you see market participants coming up with these neat, elegant stories about huge option activity, market makers needing to buy the underlying, you have this situation where volatility is going up, the market's rising too, and everyone comes together and puts these very nice stories together as to why certain things are happening. What's your take as an analyst on the company when you see a $2 trillion name move 6% seemingly on nothing? What do you say to clients, Amit?
It's a very fair question. I think one of the lessons with Apple over the years has been you want to always own this name into big product cycles, into big product launches, and certainly you have one of the more sizable product launches coming out today. So I suspect there's a big element of excitement around these products that are coming out and what the demand would look like on the other side of it that's driven the stock higher. But this is not terribly different, I would argue, from what you've seen historically. It hasn't been a $2 trillion market cap company, but the stock has typically done well into product launches.
I just love that they get really excited on the Monday, as if it's a surprise. Amit, great to catch up, sir. I'll leave you alone, I promise. Busy day for you. Amit Daryanani there of Evercore. JP Morgan actually down now in early trading. It's 12 minutes into the session. We're off by 0.6%. Listening in on the call, Bloomberg's Shanali Basak. What are you hearing, Shanali?
It's interesting that they're down now, John, because Wall Street, as we know, was very excited in the morning when we saw such lower loan loss provisioning. There is some bad news going into the end of next year. That is delinquencies rising at the beginning of next year, charge-offs coming in toward the end of next year. But the one question that analysts kept on going back to is the rate headwinds that JP Morgan might be facing and how they may react to it. How much it would offset these tremendous gains we've been seeing at the investment bank. Jamie Dimon and CFO Jen Pipsack made absolutely clear that they are not about to change their business model on what Jen Pipsack called temporary rate headwinds. Now, this is going to be important, as we know, for Bank of America tomorrow as well. That just creates so much of its revenue from its loan businesses.
Looking forward to the coverage, Shanali, through the week with Shanali Basak on top of the Wall Street earnings for Q3. Coming up, Europe tightening restrictions as the race for a COVID vaccine hits a little bit of a setback for J&J. That conversation on the economy with Mark Zandi of Moody's Analytics coming up next on Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
16 minutes into the session, equities turning just a little bit lower, down 1/3 of 1% on both the S&P 500 and on the NASDAQ as well. With the sector price action back with us, here's Abigail.
John, with those very small declines for the major averages, not surprisingly, the sector composition beneath the surface, neutral to a tad risk off. If we go into the Bloomberg and use the IMAP, it's going to look more risk off than it is, mainly because most sectors are lower, but the declines are relatively small. On bottom, the rate-sensitive sectors, utilities, interestingly, down, real estate down too. And I say interesting because we have yields on bonds down. That would typically make the dividends look more attractive. On top, we have the communication services sector being helped out by Disney, that stock popping, helping that sector be one of the top sectors on the day. And then over the last 5 days with yesterday's big tech rally, that's where it's at. The big sectors over the last 5 days, and this really is a reflection of yesterday, mainly, John, discretionary, think Amazon.com, tech, think Apple and Microsoft, communication services, Facebook, Alphabet, along with Disney, and then the financials trying to peek in there. It's going to be interesting to see, of course, what happens during this earnings week, but over the last 5 days, financials, the fourth best sector.
Abigail, thank you. Let's turn to healthcare, shall we? Johnson & Johnson topping earnings estimates and boosting its outlook for the second time this year. The strong results coming just a day after temporarily halting its COVID vaccine trials following an unexplained illness. J&J writing in a statement the following. Following our guidelines, the participant's illness is being reviewed and evaluated. Adverse events, illnesses, accidents, etc., even those that are serious, are an expected part of any clinical survey, especially large studies. Let's bring in Bloomberg's Kelly Lyons for more, shall we? Hey, Kelly.
Hey, John. Well, we don't have many specifics on this illness at this point, just that it's being evaluated, and J&J is promising to reveal more details after further investigation. But what's notable is that this isn't the first time we've seen something like this happen. AstraZeneca just last month had to pause its own vaccine candidate trial due to an unexplained illness. Granted, that study has resumed in a number of countries, but it is still halted in the U.S. Both of these instances, John, could contribute to concern about safety as companies rush at unprecedented speed to deliver a vaccine. Remember, both J&J and AstraZeneca received grants from Operation Warp Speed. It's the U.S. government initiative to get a vaccine as soon as possible. Urgency, really the name of the game here, John, as we see a resurgence in virus cases all over the world. And as a result, in Europe, you're starting to see many tightening restrictions. The UK Prime Minister Boris Johnson just putting in restrictions on bars and restaurants yesterday. Similar scenario playing out in Italy, France, and the Netherlands expected to do so as well. And that is starting to weigh on sentiment, John.
Kelly Lyons, thank you very much. Mark Zandi of Moody's Analytics discussing the connection between the pandemic and the recovery, writing, quote, the most serious blow to the economy will be the failure of Trump and Congress to agree on more help for those hit hardest by the pandemic. There is a clear relationship between the healthcare crisis it has created and the economic crisis. More infections results in a weaker economy. Mark joins us now over the phone. Mark, great to touch base with you, sir. I would love your view on what you think is happening with this relationship at the moment, not just in the United States, but across Europe right now, because we're living it.
Yeah, not good. The trend lines here don't look very good. We are seeing infections start to rise throughout much of Europe and increasingly throughout much of the United States. And the healthcare professionals obviously are warning us that given the colder weather, people going indoors, more likely to see more infections going forward. So the healthcare crisis, the pandemic rages on, and obviously the headwind to the economy is quite significant as a result.
It's worrying, Mark, because it's October 13th. It's not November. It's not December. It's not the depths of flu season. Here we are in October, staring down fall, and we're already looking at these issues. For you, Mark, the conversation on Wall Street is pretty simple. It's if we'll get a stimulus package, and overwhelmingly, my guests say we will. For economists, it's more about the when and the substance of that package, and the longer we wait, the more damage we will do. Can you speak to that, Mark?
Yeah, sure. I mean, we've had the headwind of the pandemic, but we've had a very powerful tailwind from policy, both monetary policy. Obviously, global central banks have been very aggressive in responding to the crisis, and fiscal policy. Governments across the globe, here in the U.S., obviously in Europe, very aggressive response, all very good. But right now here in the U.S., we're debating how much and whether we should provide any more fiscal support, and I think that's a mistake in the context of the pandemic that's still raging. And the longer we wait to provide that support, that additional support, the more likely the economy, the recovery is going to stall out and even backtrack. So My sense is that if the administration and Congress can't get it together by December, January, we'll start to see some negative job numbers and rising unemployment. So very significant mistake here being made by policymakers. Fortunately, in Europe, governments seem obviously I'm painting with a broad brush, but broadly speaking, they're continuing to provide support, and that's clearly the right thing to do in the context of this ongoing pandemic.
Mark, just on the fiscal aid in the United States, one thing I'm still struggling to get my hands around is how much aid is still in the tank. We saw savings absolutely explode. Clearly, not all that money was spent over the last several months for much of this year. Mark, how much is left?
It's gone. It's largely, almost totally expired. I mean, all the supplemental unemployment insurance benefits, that expired back in July. The Paycheck Protection Program money for small businesses, that's gone. Of course, the stimulus checks, the bulk of that was sent out back in April and May. Now, you do still have people who have saved that money, but, generally those are higher income households that didn't need to spend it. It's the lower income households that blew through that stimulus money and don't really have anything in the tank, as you say.
Well, that's what I'm getting at, Mark, the consumers and how much money they've actually got left to spend. And I'm trying to understand from your perspective, we avoided an income shock becoming an income crisis and turning into a huge deleveraging process for many companies and the bankruptcies that could have been a whole lot worse. Do you think this time around the nature of the next dip, so to speak, if we don't get the stimulus, could be quite different?
Yeah, that's a great point. I think a lot of businesses were able to kind of sort of navigate through, piece it together with the PP money. Of course, consumers were able to hang in there to some degree because they got all that income support from the government. Now, this go around, particularly if the pandemic intensifies here and infections rise and we have to go back to limiting business activity, it's going to be very difficult for these businesses to make it through. We'll see more business failure. And the scarring effects, as economists say, will be much more significant, make it much more difficult for the economy to get back on track and to get back to full employment on the other side of the pandemic. So you're absolutely right. The second time at this may not be nearly as graceful as the first go-around because we're just not getting that support.
Mark, I'd love to get you back soon, just ahead of the election, and talk about some of the scenarios that you're looking through, because I know you've done a tremendous amount of work on that, and we touched on it the last time we caught up. Mark Zandi there of Moody's Analytics. Coming up on this program, the market-moving events you need to be watching through the rest of this week. Your trading diary coming up from London and New York. This is Bloomberg.